the Lord has made, and Bible says that we shall rejoice and be glad in it. So I want to take this opportunity to thank Transformation College for giving me this platform to be able to uh, talk to us or lecture us about accounting. It's all about transforming life. And Transformation College has been a top-notch doing that. Kudos to them. And I want to implore all us, we the students, to take it with all seriousness. And I believe that we are all going to be transformed at the end of all this, or the lecture, and the end of the lecture section at the same time too. So without wasting much of our time, because time has really gone fast spent. So we'll be talking about accounting. Let me share my screen so we can all see. Okay. So we'll be talking about accounting, and it is now a part of our life that we need to take with all seriousness when it comes to accounting. So, as you can see,
Sorry, Mr. Sam, please can you put your PowerPoint in presentation mode so it'll be easier for us to see?
okay, yes, so I'm working on that now to put it in
All right.
in that mode. Okay, so
Thank you.
so the program is Business Management and Information Technology with the web, and the course is Principle of Accounting 1. Principle of Accounting 1. So I will have just loved to even ask everyone of us what is accounting, but because of time, we'll be discussing everything. So I would like us to ensure that this is an interactive section. It's not just going to be just one line or a monologue. It's going to be a dialogue that I chat me from the message box, or you can unmute your mic and we discuss and everything. So introducing us to accounting. But before we talk about accounting, there's something we need to also even talk about, which is about bookkeeping. Because there's no way we can talk about accounting without talking about bookkeeping. Well, first of all, count, accounting, from the word count, it means you have to be responsible for something, take cognizance of something, count something, be accountable to something. And in every part of our life, we are all accountable to something. And even if we leave this earth too, we'll still be accountable. You have to give account of how we spent our life. So this tells you that when it comes to accounting, it's not something we just take it slow. So we all have to account for one thing or the other. But we are limiting here when it comes to business in this aspect of our life. So when it comes to our businesses, how have we been able to manage our business? And this is when accounting comes in. So, but first of all, we talk about bookkeeping. You need to keep record. I always tell people, check every business you feel all around you, either the conglomerate businesses, all those big businesses, down to the smallest business you could ever see. There is always a record for those who are serious. And businesses that you can see now that are now so that you can see them that are none over the world. They started from little, and because of the proper way of keeping their account, proper way of counting things and counting accurately, and making informed decisions, they began to expand. And we now know them all over the world now and seeing them because they started from somewhere. And that is how business grow. That is how you see all those business, that's how they grow. Check the POS at the at the roadside. Check Mr. Chukudi having his electronics in his shop. Check your ability, or maybe having a whole canteen and everything. There will always, if you look around, you will always see a book recording something. They're not just recording it for fun, they're recording it for a purpose. For a purpose. So we will call that bookkeeping. So what is bookkeeping? It's just the act of recording, classifying financial transactions in a systematic way. So that is to tell you that every time there is a sale, someone will go ahead, open the book, write the date, write what it sold, write the amount on it. They keep record of all those things. They keep record of all those things. Bookkeeping. They keep record of it. Even to also to because we get to the fact that looking at that POS so minute, that POS, ordinary POS stuff, okay, why should I be keeping record? But they also keep record. So every transaction, either someone comes to receive, there's always a record. They write it there. This is the amount this person collected. This is the bank that was charged. This is the amount that was gained. This and this and that. So there's always a bookkeeping. Any business that you did not see any record kept, I can tell you for a fact that business is going straight down. It's going to dive and it's going to suffer and going to maybe it's not going to go on extinction. So that is why it's very important for there to be record keeping. So bookkeeping, let me emphasize it again, is the act of recording and classifying financial transactions in a systematic manner way. So you enter them appropriately. As it was purchased, you write enter it. As you buy goods also into your shop, you record all those things you bought. And in fact, you will already have the receipt of it, having every detail of everything you bought. You keep record of it so you will know if what is done, what is sold, and everything. If this stock is already getting out of these goods already getting out of stock, you know how to receive so that when customer comes, you don't tell them you don't have any more so that you won't lose your customer. All these things are based on that. And that is what bookkeeping. And it's very important for every business to have such things. You keep record of all these things for you to know how far you've gone, what you have sold, how much you gained, or how much you lost, and what next to do. So that's what we call bookkeeping. So then to now go at to now move further, you now start talking about accounting because bookkeeping is just the elementary stage. The elementary stage that every person, you don't even need to go to university for you to know how to do bookkeeping. You don't need that. You don't need that. Even if you don't have idea, it's something that someone can just teach you within hours or within a day, depending on how you can actually know. Just keep record. That is just keep record. But now advancing further again, going further, we now talk about accounting. Accounting. So is the advanced definition of the bookkeeping, which is accounting is now, even though bookkeeping is about recording and classifying of transactions. Accounting too is also recording and classifying, but does not stop there. You create, you summarize, you communicate, you interpret this financial information to those, to the stakeholders, the shareholders. These are the people that are interested, they want to know. So every record said, there are many people, a lot of people attached to that record. They want to see that record. They want to know what's going on. What they can either invest, either enter into, or one of things. They want to know. That's why the record is there. That's why the record is there. So accounting is defined as a recording. Every transaction that comes on, you record it. Classifying. You can have your purchase book, day book. You can have your sales day book. You can have your any goods that was returned. Have a separate book for it. Maybe somebody is still owing you. You have another book for it to classify. Creating and summarizing. So when it comes to summarizing, so it doesn't mean I say, at so time, this man came here. He was saying good morning. We don't need all those long stories. Just classify it. Just say this also date, this is the amount. It was the person, the name of that person. If the person didn't pay money instantly, you can write the name of the person. Just that it's owing you. This is the amount to classify it. Then you communicate it. People seeing it, we see that if your boss now come and see the account, he knows that he understands what it because it's the language. He understands it without having to be a textbook, writing it in theory and everything. Classifying, after being classified, he understands, he communicates, then he interprets, he knows what he's saying. He knows what he's saying. And with that, he knows what to do. He knows the decision he needs to make. He knows the decision he needs to make. So interpreting financial information to interested party in order to help in making business decisions. That is the reason why you make business decisions. Every decision is made by seeing the record, financial statement of a company. You know what decisions to make. Am I to buy the shares of this company, seeing their financial statement? There's some things you need to look out for you to now know, okay, should I go ahead? Should I not go ahead? To make decisions. And it may also for even the owner of the business, should we go ahead? Should we do this or not to do this? Seeing the financial statement. You more or less are giving account of what the business entails for the whole year. What have we done? So that's what it means. So which we're talking about accounting, as you can see. So bookkeeping is only limited to recording and classifying, just records alone. A primary six student, a primary six candidate, or even less than that, in as much person can read and write, can do that. But when it comes to accounting, so you all know that accounting is a profession on its own. So going to that field, then it's a big time course that has different tentacles. Either you want to be a management accountant or an auditor or cost accountant or this and that, have depending on the field you want to do. That's what accounting is: recording, classifying, creating and summarizing, communicating, interpreting financial statements to people so that they can make informed decisions, business decisions, and everything. So let's look at that within for this account. So what is now the difference between bookkeeping and accounting? So based on our explanation, as you can see, so bookkeeping, as I say, is the act of just recording and classifying, which is linked to that. But when it comes to accounting, it's recording, classifying, summarizing, analyzing, interpreting financial statements. The majority of us, anytime we pick up the financial statement of a company or a bank, we only just see it, we don't know what to look out for. But there's something, somebody who is inclined, who knows about accounting, will know what to look out for in the financial statement and ledger. So somebody cannot just, so you know all those things. You know all those things which only the eyes of an account you can, if you look through the eyes of an account, you know either if someone just comes, why can't you buy this? We're looking at it, no, I can't buy this because I can see a red flag. I can see a red flag in this place, so I cannot. So someone will not just push you into it because you know. Only those who don't know, when they just send it to them to go ahead, and at the end of the year, at the end of the day, discover that it is just a loss, just a loss or a mess for them. So these are the things we need to look at for. As we continue, we are going to know about it. So it involves routine recording of transactions, and it is the simplest aspect, which is the bookkeeping. Very, very simple to do. Very, very simple. If you can read and write, you have retentive memory. You are someone who is actually somebody that will know that anytime a customer comes and record and everything. So it's very simple to write and everything. But when it comes to accounting, it is more complex because it involves designing of the accounting, to create this column, to design it has to be in a way that it will be very explanatory that anybody that sees it or understands it. So that's what accounting is. So bookkeeping also, it is only a small part of the field of accounting and is limited in scope, as I have said. But in accounting goes beyond that. Recording of transactions in a wider scope. You can't use the same account of Dangote with that of a microfinance bank. And you cannot use the same bookkeeping of a microfinance bank with another account, or let's say a POS. It's a different kind of account. So it depends on how big the businesses are. So the bigger the business, the bigger the account, the wider it's going to be, and the more all those accounting transactions and processes and the book they need to keep and everything. And the more decisions they need to make. Because no one wants to start a business and expect it to fail. Nobody. There is I want to start a business and I don't want it to fail. Nobody has that intention. So every business, every business that fails, there must have been a reason. Either they don't keep account or maybe other external factors that could happen. External factors. And it's peculiar to individual countries. So one can be proficient, be a proficient bookkeeper in a few weeks or months, or even less. But when it comes to accounting, you have to become a professional accountant and requires several years of study. After studying 4 years in school, that there's even no strike too. It's a long heard about strike, and we pray that there will be any strike anymore. So 4 years, then those who want to go further again, we go into having to be a professional accountant when we talk about ICANN, being an ACCA, being an ACA. So we learn further again to know more about it, because it's so wide in scope. It's so wide in scope. So accounting, as I said, is all about recording. Record everything that happens. Record the transaction that happens. Take account. Take your business as a human being, but an artificial human being this time around. Recording everything. Recording everything. So with that, it will help you in ensuring to make decisions and the business to grow. So who are now the users of this account? You being the owner of the business, you are not the only the user of the account. You are not. You are only the owner. There are many people that also are interested in your business. Many people are interested in your business. So we're going to make it interactive in this aspect. Owners of business. The owner of the business actually obviously must be interested in his own business. If you are the owner of the business, you need to be interested in your business because you want it to grow. You want to have a lot of money with it. You want to grow like those big conglomerate companies too. You want to, so that's what you are. You want to be part of those who are competing really in the market. So owners of business, they are interested in it. So what are the things? What is that thing the owner of a business will be looking for in his own business? What does he want in his own business? Why would the owner of a business be interested in his own business? Can someone tell me? Why would the owner of a business be interested in his own business? Just one person to just tell me. Owner of a business, you can unmute, just tell me. Let's make it true. So if you have a business and you are running, why are you so interested in that your own business? What are the things you want from that business? Yes, someone on the call, please tell me. Someone should tell me. Okay, why still thinking about that? Okay. Why still thinking about that? So or you can put it on the chat. If you okay, I thought I was checking the group chat to see if there's any. Okay, good. So for profit, that's a achieve. For profit, so to make profit and for stability of business on the long run, fantastic. Yeah, so for profitability and growth, yes, that's what the owner of the business. Nobody wants to go into business and want to make sure. You don't want that. You want for profitability for a long time because you want business continuity. You're not even thinking just 5 years and then I'll be low. You want it to continue. You know, that is making profit for you. So that's what the owner of the business is interested. What about the management and employees? Management or the employee. What would you think the employee or the manager that they employ? What do you think they will all need from the business? Why would they be interested in the business where they are working? Why would you think they will be interested in it? Yes, why would they think they will be interested in it? The management will always want to know the profitability of the business, which any other one it is. They also want to know the stability of it too, which is very important too. They want to know if it's stable. They want to know that if their salary will be coming as a well due, They want to know that, okay, at every single time the salary is coming in, they want to know the profitability of the business too. They always want to know. So the employee will be interested in such business. That's why, yes, earning their salary, they want to know that, when it comes to, when you're in business, when you're in company, that you discover that the salary is being made, then there's something going on. It means the health of that business is going to deteriorate. You're supposed to collect salary at the end, maybe at 28th or 29th, or maybe the last day of the month, and you discover that it was not paid. It was delayed. First month, maybe it was delayed by a week. Second month, it was delayed by a week and some days. Third month was delayed. Fifth month, it was delayed and they paid you half. Mm, there's something. It's because of this record keeping. So because he knew, he's seen the recognized things and everything. So all these things are what. So with this, the owner of the business can say, what can we now do? That is when they now start making business decisions to ensure that things like this does not come up. So that to ensure that we keep our we keep our employees and everything. So we don't have fast turnover and everything. So as a management and employees, if the business grows, they also grow in finance, good by the books, certificates, and for promotion. Yes, exactly. So true. Yes, yes, you're right. Jairo, you're right too. So because the business grow, there will be promotion, there will be increments also in salary too and everything. So shareholder, as shareholder, what is your what is the what as a shareholder? Good. So we have return on their investment for shareholders. Some of you have bought shares, and I know you know the reason why you bought those shares. There must have been a reason. Of recent now, some banks came to the public selling shares because of the policy the CBN gave to them that they need to increase their capital after this and everything. And the only way to do it is just to sell much to the public. And some of you bought it, but you can't just go ahead and start buying shares just like that. You need to now check other things. Is this company, is this bank, does it have the potential of growing? And how can it go? Can it go at a geometric proportion? Or it's going to go with small? So if I buy into this thing, what am I going to enjoy? So as a shareholder, we know who shareholders are. Shareholders are those who invest their money, who put their money in a business. So become a shareholder to that business. So when you buy shares, that your own money is in that company, and you are also part of the owner of the business. Although you might not be able to make decisions because of the percentage of shares you buy might be so insignificant, but at least you have a part in it. So return on their investment, they want to know. They want to dividend too. Dividend. That's why shareholder wants to know, because every company, all these big companies, the PLC, they must declare dividend. Okay, because if you invest, so at the end of you are doing 1 naira per share, you are doing 50 kobo per share. So the more the number of shares you buy will be determines the amount of dividends you get, which is done annually. Sometimes they do it 2 times in a year. They do it 6 months, and they realize the final 6 months at least. Say thank you. We've made profit, so take this. We've made profit, you to take part of it. But you still have your own share, the share capital which you have, which also continue to appreciate, which you have also continue to appreciate. They want to see how your capital, the share you bought, is growing. You can buy it at the rate of 15 naira, but within 2 years, you just see that 15 naira appreciate to maybe 30 naira or 40 naira or 50 naira or 200 naira. You gain a lot. So it's not for you to now sell. Sometimes they even declare bonus, give out bonuses too. So increases your shares the more. They give you the privilege of, even when they sell shares to the public too, you buy it at a very low price as compared to how it's being sold to the public. Right? That's what shareholders. So that's why they need the financial statement to know. So you see all these things, you see when you start comparing the last year with the previous year, with this year, and you can see there is a growth. Government, what will government lead your account, your financial statement? What will government be looking for in your financial statement? What will government be looking for in your financial statement? Government to ascertain the tax return the business needs to settle their tax obligations to the revenue authority. Yes, yes, okay, government tax. Okay, that is the manual. Set to ascertain the tax return. Yes, exactly. So they want to know the tax bill because it is compulsory. You need to pay. It's your civic responsibility because tax happens to be one of the major source of income of government. Taxes, taxes is one of the major sources. So for government also to plan for the general public, they are interested in your business. They look at it, how much profit is made. They now ascertain the tax needs to be paid, which is used to make their own budget too. That is why it is very important for government to make sure that the environment is conducive for businesses to grow and strive. Because when it grows, the more the business, the more the revenue for them, and the more they also get more revenue to able to do things, essential things, roads, schools, public schools, this and that, for people to enjoy. So So if government makes, that's why they make policies that will best suit government. But if you make it so toxic for people, how will they now get money? And you now see that it's not a good thing. It's not a good. So government needs for tax purpose. They need to, and also sometimes to regulate. To do regulations too and everything. So let's quickly run faster because of time. So loan creditors. Why will creditors be interested in your financial statement? Why would they need information of your financial statement? Creditors. I guess we all know who creditors is. You know, sometimes some shops they say no credit today, call tomorrow. That means they are not ready to sell goods for you on credit. But there are some business, sometimes some of the things for business to go into that you buy goods in credit and you now pay back. So the creditors. So why would creditors want to 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 know about your financial statement? Why? Why would they think they will want to know? They want to know that, okay, so Emmanuel is saying to ascertain whether the business is financially sound to settle their debt. Good. So because sometimes if you want to go ahead, if you go to bank and you want to get a loan, the next thing they will ask you, bring your financial statement. They want to see. There are some things they look at. They are not looking at your name or there about the name of your business. Those records you make, they're talking about that you need to classify, you need to record. So they interpret it. Remember looking at the interpret and tell you, oh, this person can pay when you go to bank. Oh, this person can. I think we can see that this business can grow. So they give him this amount and he puts it into the business and it can multiply and can grow. So these are things they look at. And even though creditors they start looking at the progress. Okay, money is working. This person has the ability to pay as they have promised. Has the ability to pay. Yes, to get their principal and interest. So they all read all this. Just look at it. Imagine you don't have record of all these things. Imagine you don't have record of all these things. How would the employee or the management want to how would the shareholder want to buy into your business? How will government want to make decisions that create policies that if imagine you don't have record? How will no creditors, banks, whatever, will want to loan if you don't have record? To reason, see how important the records are. So genuine. Our record as teacher means that you just need to record. Supplier, suppliers, you sell provisions and everything. Suppliers also want to know because those manufacturers, they also want to be interested in your business. Your business is going fine. They know that yes, you are selling their product very well. They always want to supply you more. They always want to supply you more. So suppliers also too, they are interested in your business. So they help in ascertaining the credit worthiness of the organization. So they want to know whether the business will be able to make profit for goods purchased. They want to know whether the business can make profit for the goods they supply. So suppliers are interested. Customers too also are interested in your business too. Everybody is interested. So customer wants to ascertain the financial position of the business. They also want to be able to ascertain whether they want to know the strength of the business. They also want to be sure that yes, you will be able to supply them every time. you are capable of supplying them every time. Are we sure Dangote is ready to supply us petrol every time without importing it? So we want to know. We as customers want to know. So that we could stop. Government will not know. Is he able to supply the whole nation with his refinery, which is the biggest, if not in the world, almost the biggest in the world, 65,000 capacity, 60,000 capacity. So they want to know if it can supply. So we just let us stop importing. That is it. Competitors too also want to know about your financial statement. They are really interested in knowing your financial statement just for comparison. That's comparing. So competitors want to say, if this company A is doing like this, you compare with it. We're in the same industry, we're in the same environment, the same external factor affects us and everything. But if it's making it, why am I not making it? If it's making it into profit, why am I not making it into profit? So you know what to do. You know the decision you need to make. These are competitors and potential investors too. They also want to know. So if either to invest in such a business or not. The public also wants to know, just to know the economic considerations. If they can, public wants to know if they can actually go there to be employed. They have chances of being employed. As Dangote just said, his refinery at Lekki, it shows that those the public, those people around them, they have the opportunity of being employed at that environment because business is interested. So that's why the public also is interested in it, so that they know that people around there, those who are employable can be employed and everything. And also the social economy they will enjoy too, the corporate responsibility, maybe helping them to tie their road and everything, so they make profit, they help them tie road. Nobody does that very well, tie a papa road, because they know that there's big roads that go there with cement, with concrete and everything, not using asphalt and everything. So all these things, these are the users of accounting. These are the users of accounting. So now, what about the history? How did it start? How did it start? History of accounting. Early beginning, it has been accounting has started way back, way back, not before. And it traced back to the time of the ancient Rome, those Egyptians, Egypt era, and everything, Mesopotamia, those countries and everything. So another time, what they sometimes they use all these tablets. They're not talking about electronic tablets. You just write it using kind of a chalk and a tablet to write things, taking stock count of things, of their agro business, of their sheep, of their gold and everything. You start writing it down. That is where record keeping started. Start recording it of their stock, of their livestock, of their agricultural products and everything. That's where accounting start doing it and start counting it. They start counting it, okay, this and that and this. So it started from there. Back many, many years ago, thousands of years ago, till we moved to, that was early beginning. Then we moved to the medieval era. So it was during this time that trade and commerce started. Trade and commerce, you now start seeing trade. So the need for more sophisticated accounting grew more and more. Due to now start doing more accounting because now getting more somehow complex to some extent. So, and this man is this Italian monk called Luca Pasolini in 1494 has now published a book called the book is called what is it called? Summa de Arithmetica. That's what it's called. And it talks about double entry. We're going to get to when it comes to double entry because that is the main thing of accounting. Double entry. That is the main thing of of accounting. What you know about double entry. So we talked about when there's a giver, there must be a receiver. So when money comes in, it's coming out from somewhere and it's going to somewhere. So, which started at the medieval stage, which we've seen. Then thereafter, we went to the industrial era, the industrial era stage. The industrial era stage is now up to those time when everything now starts, when there are now industries. Great industries came into being. When you have big industries, during those times of Rockefeller, um, we have the time of Rockefeller, the Morgan, Morgan Freeman, or this and that, all those great industries. So we now have that. With this, then we now start having accounting to be, it's not getting complex, but you now have to make sure that they have a body to make sure that the accounting you're doing has to be has to correspond, has to be in alignment, has to be the same everywhere. So it's not be I am using this aspect, you are using this aspect. No, that's why we now have bodies like the American Institution of Certified Public Accounts coming together, the Chartered Institute of Management Accounting of England and Scotland coming together to establish accounting principles, accounting ethics, accounting convention in a way it needs to be written. Professional now start coming in. Professional bodies now start being created so that accounting can be in uniform. Uniformity will be. What is being done here will be the same thing done everywhere. So that's the Industrial Revolution. Then it starts evolving. Accounting starts evolving. It starts evolving. Then we have the 20th century. The 20th century, where there was now, everything now boom. Businesses now start going up, moving on. Different kind of businesses now start moving in. Technology start advancing. Things start advancing and everything. So that's where you now start having the Security and Exchange Commission and having this and that, other things. You have the gap, which is the generally accepted accounting principle. They now start working on accounting principles whereby you have the same way accounting is done here. Was it the same way it's done in another country? It's done in another country. So we don't have diversity. We don't have different ways. So that anybody that picks in this country, if you pick another accounting financial statement of another country, you understand it instantly. So there are some principles laid down that we need to follow. We'll talk about that. So we have all those ones. We have the International Financial Reporting Standards. They are trying to make it to be standard, not to be something. So that's why you have the a body is now being created, international, the IFRS, creating so standard of this transaction. As we go ahead, we understand them more and more. So this happened in the 20th century. So, and we have the modern era. At this time, as you can see, the Gen Z time we have, the Gen Z world we have, everything is advancing. Technology is growing higher and higher in a rapid way. That you could also have to follow. If you are being led, if you don't follow the moving train, you'll be left behind. Advancement in technology, you see those accounting packages that help in simplifying accounts. It helps in simplifying accounts. It helps in making sure that the account is done in a simple way, not making it complex. So these are the things accounts in the modern era. Advancement in technology, revolution of accounting practices. All these things are being done. Have those artificial intelligence also helping us. Artificial intelligence, and we all know all these things. So artificial intelligence also help us so much in advancing accounting practice. It helps us so much in advancing accounting practice. So that is that for the history of accounting. So as we have talked about the users of accounting, those who use it, those who need financial information, same thing to apply to. Then we'll be talking about the importance of bookkeeping. We all know, in as much as know the users of accounting, then obviously, definitely, we will know why it is important for us to keep accounting. Why are we keeping accounting? So as you can see, for profit purpose, users of accounting for profit purpose, that's why you can see there, for profit purpose, for profitability purpose, for decision making. So as I say, the financial position, you know the position of your company, you know how much profit you make and everything. And if you know how much for the following year, to plan again, to plan. Okay, if we made 50, if we made 100 million this year, let's look at them. All the revenue we'll be looking at for next year. Let's go ahead for another 150. Let's target 150 for the following year. So you plan. You've spending so much on this. Let's try and reduce the expenses you've done on this place. So for all these things, you make plan and everything. So also to ascertain your assets and liability. When you see your balance sheet, you know the liability you are incurring. So how do we settle all those liabilities? How to get more assets so that it will boost our business. So that we'll be able to get to that place we are talking about. Also, to prevent fraud, also you need to keep accounts for you to prevent fraud also too. If you don't keep accounts, how will you know? So but from your record, you see that okay, need to prevent fraud. To monitor the progress of the organization also, so which is very important. You know the progress of your business, how your business is going. But if there's no record, how will you know your business is growing? So, and for economic comparison, for economic comparison. So now we are moving straight into the account itself. So if you've known all those things, you've known all these things, then what is the account itself? The practical aspect of it. The practical aspect of it. So the fundamental framework of the entire financial accounting process is this. There's an accounting equation. Know this, write it somewhere. Is this. Asset, your asset equals the capital and the liability. Your asset equals to the capital plus liability. That's it. So what is asset? What is capital? And what is liability? As you can see, assets, these are the properties. The assets are your property or resources of a business organization that we are talking about your land, the building, the office, if the owner of the office, you have this, your generator, your vehicle, your furniture at the office, your fitting and everything, the cash you have at hand, one at bank, your treasury bill that you bought on behalf of the business, these are your assets. How do you not get these assets? How do you get the land? How do you get the building? How do you get the cars, the vehicles, the land, the generators and everything you have? How do you even get the money that in your account, so the one you have in your pocket, your furniture and fitting? How do you get it? Is now the capital or the liability? Is that how the money comes from your own pocket, or you borrowed it from someone? So when you borrow it from someone, all these two make up your asset. So capital is the total money provided by the owner. Start business. If you want to start a business, at least you have some change with you. You have some change with you. You have some money with you. But the money might not be enough. So you need money from some people too. So that is called liability. So it is the indebtedness of the company to the outsider. You collect the money from them and you're able to set up your business. You want to start what kind of business? You look at it that it will cost you to start this business, it will cost you 100 million. But I only have, let's say, let me not go that further. It costs you 50,000, maybe small, let's start from small business. Small 50,000 naira, but you only have maybe 30,000 or you have 20,000. How do you get the remaining 30? So it's by calling your friends or calling this and that to get the money together. And that money, you're not going ahead and squander the money and go and chop the money. No. You used to buy one or two things. You buy tools, you buy materials, you buy all those things. So all those materials you bought and the leftover tools that you have that will be in your account, these are called the assets. So accounting equation is equal to it is asset equals to capital plus liability. Capital plus liability. So which you can see there. So just note that. Note that. So what are the roles of an accountant? So having an accountant at the office, or you being an accountant, or you trying to look at your business. So what are their roles? So we need to know their rules and not just get sitting down. So there are rules for normal recording of all transactions. So anybody you employ, you know that each person needs to record transactions, record every transaction that happens, all the transactions that happen at the office, at the work, at the shop, this and that. Record all the transactions, preparing financial statements at the end of the month, prepare a financial statement at the end of the quarter, at the end of 6 months, and or at the end of the year, another financial statement. They prepare the financial. So these are their rules. The budget too. They make budget. They make budget. They forecast. These are the roles of an accountant. They do auditing too. When you have your internal auditors or your external auditors, they go there to audit if there will be any discrepancy or if there will be any kind of fraud. These are things do those checks, check and balance, check and the check and everything. So some things maybe you erroneously wrote, you erroneously put down, mistakenly put down. So auditing will be there to check to correct it. So these are rules of account of an accountant too. They plan for tax too, but you need to pay the government too. You plan for the tax, how you pay your tax, you pay all the necessary things needed to be paid. You analyze financial statements. If you have the idea, you analyze it for them. This is what's going to be. This is how it is. You analyze for them. We cannot go ahead and pay this so because it disturb our working capital. If you pay this so, we will not be liquid. There will not be enough money. Because of that, we get stranded. You analyze for them. You let them know what and everything to do. Internal controls, just like an auditor, put some controls in check so that there will be integrity in the financial statement. You put some controls in it, you check it, you put some checks in all those things. So internal controls too. So management accounting, tell the management about everything is going on, so that's how we advise them also. So give them advice, financial advice on what to do, on how to do it. So these are the rules of accounting. These are the rules of accounting. Okay. So now the principles of account. I hope you can hear me clearly. I hope we are all together. I hope we are all together. If you're all together, you can type 1 at the chat box so I can check. Just type 1. Okay, good. So good. So we are together. Thank you. Yes, 1 star by star. Thank you so much. So we're all together. Good. Thank you. So thank you so much. So principles of accounting. Now let's move further. So as you can see, you are building something up. You are building something up so that you can know, I can see and everything. Reason why you need to take records. So if you have those ideas of you want to start your own side hustle or you have side hustle and you're not keeping records, the side hustle can collapse. You don't even know if you're making profit. You don't even know if you're adding some people's money to your money and you think you're making profit. Yet you're not making any profit and you think you're making it. So records gives you ideas. You know, if not even that alone. Even sometimes, even your as a salary earner, if you're not excuse me, if you're not keeping record of how much you're spending on your transport, how much you're spending on food and everything, you just before the end of the month, you're stuck. You don't feel health again, start borrowing again. But if you keep record, it gives you make you have decisions. Next month, if I get my salary, I must cut down the cost of this. I must cut down this and that. So that's why recording is very important. So principles of accounting. The principle of accounting is also known as the generally accepted. You can see generally worldwide. That you can see the history. When we talk about those history, it started from just counting this, counting that, as it evolved in those industrial times. They discovered that accounting is getting wider. It has left the bookkeeping stage. It's now going to the real accounting. So because of this, so we need to have a body that standardize accounting for us. So there must be some things that we need to generally accept that, okay, this is how we are going to be doing this. This is how we are going to be recording this. So that's the principle of account. The principle of account, also known as the generally accepted accounting principle. It tells you that the account you prepare in this company A, if you are in the same company, if you are in the same industry, then it must be the same thing you must be doing all through. So the account preparation of the bank is different from the account preparation of the manufacturing company. There are two differences because they are not in the same industry. But GT Bank will not prepare a different account different from Access Bank, will not prepare another account different from First Bank. The account will be the same when it comes to the principles they need to follow. It must be the same. The moment you step out of it, that means your account is not counting. That means your account is wrong. That means you are not following it. That means it's substandard. It's not up to standard. So it has to follow. And it's because it's generalized, it's global. So the same way account is prepared in the same industry, a bank in a country will be the same way prepared in another bank in another country, prepared in another bank in another country. It will be the same. Only difference will just be the currency, which can be converted. So when you go to when you now start in advance, so we talk about currency, how to convert and everything. So it's so very wide. But there are some principles that are generally accepted that as an account, as preparing financial statement, you must follow. So generally accepted accounting principles called the GAAP. They are set of standardized guidelines and rules, as you can see. Standardized guidelines and rules that govern financial accounting and reporting. They follow those principles. They follow those concepts. You don't go out of those concepts. The moment you step out of it, then you're out of line. You have to come back. So these principles ensure consistency. It ensures transparency. And above all, it ensures comparability. You're able to compare financial statements together. But if they are not the same, you cannot compare. So these are it. So what are those principles? What are those concepts? What are those concepts and conventions that we need to follow, that we need to check, that we need to make sure that we do? So we have the Akura principle. We have the Akura and cash principle. Akura and cash principle. We have those two. Akura and cash principle. So let me start with, let's start with Akura. So I want you to pay attention with this. So that you know. Akura principle. Just as the word says, accrued, something accrued. So we have the revenue recognition and we have the expenditure recognition. So anytime there's a transaction, we always have the revenue, we always have the money coming in and money going out. So when financial statement is being recorded under Akura basis, the revenue is recorded when it is earned, not necessarily when cash is received. Let me say it again. Revenue is recorded when it is earned, not when cash is received. Sometimes you must have sold something. You as a business owner, you're selling a laptop. You're selling laptops, you're selling goods. And somebody came, a customer came and said, supply me 100 laptops or supply me 20 laptops that cost 50, let's say that cost 10 million naira. So, but it has not paid. In your record, you already write that revenue because you've already supplied. The contract has been there, you sign and everything, you supply, but he is yet to pay. He is yet to pay, but you've supplied, you've made that agreement and everything. So he is yet to pay. So record that as a revenue. You record it as a revenue for that year. So when you are preparing your financial statement, it will be there, even though the person has not yet paid you. So that's why I say revenue is recorded when it is earned, but not necessarily when the cash is received. So that's what revenue. So that is what Akura principles say. That's what Akura principles say. So it's not going to now be in your balance sheet. You now say, those who are owing me, that is your receivables. From Mr. Kingsley, he owed me 10 million naira as for what he bought. So you now have it. There's another book again. This is classifying. It's now be there. But from your financial statement, from your profit and loss, your revenue, it will show that you sold it. Really, you sold it. The expenditure to the same thing too. Expenses are recorded when incurred, not necessarily when cash is paid. So you record it from expenses. So, but you've not made payment, like your postpaid. Not just at this time around, we have prepaid meter, so you cannot, or your phone, you cannot say you go and make call without your phone. You must have bought credit on your phone. But this time around, so when all those old meter, all those postpaid meter we have, or some, or let's go estimated, you already incurred the NEPA expenses, but you've not paid. It's not going to be at the end of the month, you now pay. So so you record it, even though you've not paid your NEPA bill, but you record it that, I've incurred it. It will be under your expenses, under your profit and loss. So these are expenses, you recognize the expenses. So you just know that in your balance sheet, you know that you are still owing that you need to pay. So expenses are recorded when you're not necessarily when cash is paid. The moment you incur that expenses and you've not made payment for it, you record it. That's what accrual principle says. And every company, all companies, they follow this concept, accrual principle. Check all of them. They follow accrual principle. They follow accrual principle. And the reason why you always have the payables and the receivables in their balance sheet, payables and receivables in their balance sheet, it shows that this thing has been incurred, but it's not paid. So they have the payable. This person has purchased this thing, but he has not paid me. You have the receivable. So that apart from company company make use of this business make use of this accrual principle. So these are things you now start checking when you see financial statements, start checking all these things. Oh, okay. Now we have the cash principle, the cash business also. So this is the opposite of the accrual. He's telling us that revenue is recorded only when they are received. Only when you collect the money. That's when you now record it in your financial statement. So that means if you have sold that laptop and that person has not paid, you don't record it as your revenue. That's what it's saying. You don't record it as your revenue. Just so until that person pays, you now record it as your revenue. Same thing happens to the expenses too. So expenses are recorded only when it is paid. So it is paid. And government makes use of this. Government cannot make use of accrual. They look at government budget, look at federal government budget, look at state government budget. They follow cash basis. There's nothing like payables or available in government, state government or federal government account. Cash basis. This is what we want to generate this year. On tax, we want to generate 10 billion. On this also, we want to generate this. On that also, we want to generate this. And based on the expenses, on road, this is the amount we are spending. On this one, this amount, on schools, to build schools, this amount, that's what they do. That's why at the end of the year, they always rush to make sure that they fulfill those things, those budgets, because no matter after that year, it can elapse. They prepare another budget again. That's why they want that money, the money for that year, they want it out. They want it out instantly, because the moment you don't do it for that year, because it's reasonable, except you budget it for the following year, you can consider. But if it was not budget for that following year, you call it put it off. Except there's always a complementary budget. Maybe to just make sure it's so important, so they put it again. Or sometimes they even extend the budget too. Sometimes it was experienced, they have to extend 2023 budget to 2024. So 2024 budget was running, 2023 budget was running concurrently in the government. So all these things we need to, so government makes use of the accrual, government makes use of the cash principle, while businesses, you have the limited liability companies, the PLs and everything make use of the accrual. So you can see the difference in it. So these are the generally accepted principles. So we have the conservatism or the prudent principle. So as someone who is preparing an account, so this principle suggests that when faced with uncertainty, because sometimes you must be faced with uncertainty. This was telling you that don't count your egg until they are hatched. Don't count your egg until they are hatched. So when you are faced with uncertainty as an accountant or as a business owner or as the owner of business, you should not lean towards you should lean towards being conservative. Be prudent. Be prudent in your spending. Don't just spend anyhow. So you think, what if government change their policy. So let me not take this decision. So you have to be conservative in things you do. Don't say everything is going on, boom, boom, and everything. You know what happened to Go Kada kind of thing. You will all remember that time when Go Kada was carrying people and everything. But the moment government policy came in, it destroyed that business, and they invested more in bikes and everything. But they are just have to improvise again. Okay, so let's now start doing Korea, carrying people's package on thereabouts. So you have to be conservative, you have to be prudent, you have to anticipate for loss. What if there's a loss? What if there's a government change their policy? So let us not overspend so that it will be for the rainy days. So and so also don't overstay gain that you are going to gain this total amount. So you have to be conservative. So this what prudency concept is telling you. So those are the accounting principles that every accountant needs to follow, every financial statement, every accountant needs to follow when preparing such account, such account. So we have the consistency principles too. So what you do, something you follow, you need to be consistent with it. If you are following this principle, don't change to another principle. If you are following cash principle, don't change following it, change to Accra principle again. If you are following and the following year again, you change back to cash principle. The following year, you change to accounting principle. No, it's not done that way. You have to be consistent in things you do. So consistency in accounting method ensure that similar transactions are treated in the same manner from one accounting period to the other. So that you're able to compare financial statements of last year to this year and able to plan further for following year. We have the materiality concept too. What is material to you might be immaterial to you. So only item of material value is significant or significant impact. Only items of material value or significantly impact financial decisions should be recorded. So what is material to you? Something that is so big to you might be something small. So you can't imagine a big company using stapler as a fixed asset. You will not. Using, okay, it's basically part of the asset. It's only a very small company can be putting stapler as an asset. As an asset. You put it in the balance sheet as an asset. But a big company will just all nice stapler. It's just small now. They put it under expenses, so they don't bother about it. So some people too, laptop from companies too. Laptop can be an asset. They put it when they're writing their list of assets, they can put laptop. Other companies, because of their so big, laptop is so immaterial to them. So they just put it so as immaterial to them. They just put it under expenses, and that's it all. Even though it can last more than 1 year. So these are material principles. These are materiality principles. So items of value that can significantly affect the execution of the business. So that's for material principles. So we have the objectivity principle. As an accountant, you need to be objective in what you do. Don't be biased. You must not be somebody that they can be pushing here and there like a wave of a wave. So you have to be objective in things you do. That's why you are called a professional accountant. You have to be objective. Say the truth. Financial statements should be based on objective evidence. So verify. You have to be objective. Don't just say somebody say I spend this and you just agree. You need to find out. Truly did you spend it? Make findings as an accountant. So somebody just comes in and say I spend this amount. And you say, okay, and just record it now. That's all. What if the person is spending? You need to find out, okay, where is he spending? Oh, where is it? Show me the evidence. Show me this. Show me that. So you need to be objective in things you do. That's why so don't say it's my family. The moment you start putting family in business, and you are shying away from things, you are being biased. It's affecting the company little by little. It's affecting. So you have to be objective in what you do. Business is business. Things to be done at an arm's length. That means what is in the market is what you need to do. Don't say because it's my party, so I remove the business, I remove the profit for me, and before you know, start killing the business little by little. Going concern principle, so it means that every person who start business wants the business to continue to grow. It wants the business to continue to grow. So you have it's the principle of going concern. But when it comes to policies and laws and rules and regulation of the government and everything, making things so when it's so harsh, it affects the business continuity of a company. It affects. So that's why government will need so that to make some decisions so that the business can be good too. You remember those times too, during time of um um I've forgotten his name before these are business ones saying ease of doing business because they know that the economy has been so hard. So let's make it easy for them to start business. Make it easy for them to start business. So going concern assumes that an entity will remain in business a perpetual for perpetuity for a long period of time. That is it. Matching concept also so important too. How do you match it with this? So expenses should be matched with revenue for that year. So it is what you gain. The revenue generated for that year must be matched with the expenses for that same year. Don't go and take last year own and not start putting it this year. You're not matching it well. That's a very wrong match. So it has to be the revenue generated for that year must be matched with the same expenses for that year. The revenue you made from that same product must be matched with the same expenses you incurred on that same product. On that same product. The revenue you generated from the production line, you must match it with the same expenses you incurred in the same production line. Don't go and bring from another expenses from another production line into another different production line. I'm matching it wrong. It's wrong in accounting. When it comes to accounting, so it has to be the same thing. So expenses should be matched with revenue generated during the same accounting period. So all expenses to generate revenue will be matched against a revenue generated for that time too. So we have the full disclosure principles too. So financial statements should be disclosed to disclose all necessary information that might influence the decision of the financial statement. Close of the financial statement. We have the money measurement principles. So we have a whole lot of principles. A whole lot of principles. So all those principles are there. Money matching, money measurement principles. So only transactions which can be expressed in monetary terms are recorded. Money that sorry. Only transactions which can be expressed in monetary terms are recorded. So we don't want to know about one staff came late. That is another separate thing. You don't put that in financial statement. One staff came late, we suspend one another staff. We did this. No. Anything monetary, anything money, this is what is needed to be recorded. The management are bad. It's not included in financial statement. You don't record that one. That would be for management something. So maybe another record for that one. But in financial statement is the money you want to see, the revenue, the expenses, and everything. So money measurement. What can be measured is money. The staff came late cannot be measured in money and everything. Cost principle. So assets should be recorded at the original cost, not their current market value. So in the balance sheet, that's where balance sheet comes in. So they are recorded at the original cost. So at the end of the only just know if there are unrealizable profits on it when comparing to the market value and this and that. Trying to rush sort of time. So business entity principles too. We have the business entity principle. Which says that the concept says that business should be treated as separate entity from the owner. So business is always, become a limited liability company. You are being separated from the owner. So it's treated as an artificial person. So it's being treated. So the business owner is different from the business. It's being treated. That's how it is. Business entity. So that's the concept. It's a business on its own. It's an artificial person on its own. So you cannot go there and be doing anyhow. You cannot be going down drawing money, taking money, spending money anyhow because it's a person on its own. So if money in the business is used to pay the owner's expenses, it must not be treated as an expenses of the business. You can see, but it will be charged to the owner's joint account, which is sometimes the owner has to pay back. And sometimes the owner asks for payback and everything. So we have the periodicity principle. Periodicity principle tells us that the accounting period of a business is always 1 year. I don't hope you can hear me. Okay, I'm still audible enough. Still audible? Trying to check. You can see hear me, please let me know. Okay, all right, good. I need, I need to know that I need to know that I'm still online. All right, good, good. Thank you. Thank you. So, as you are saying, periodicity, every account is being done, is being prepared for a 1 year. That's 12 months. It's a 12-month period. Every account is a 12-month period. That's what periodicity is. So financial performance, the financial performance of company should be divided into periods. So usually 1 year, that is 12 months. 12 months. Some people own are January to December, some are July to June, but it has to be 12 months. It has to be a period of 12 months. So check every financial statement. It will be a period of 12 months. But then most they use from January to December to measure January for their own for the period they use. So dual aspect principle. There are many more principles too also so which the international financial IFRS is created. But that's when we are going into advanced things. But these are just the basic, the elementary that we really need to know. So the dual aspect principle says that there are two aspects in accounting. That is the debit and the credit. The debit and the credit. So two aspects in accounting, debit and credit. We all have it. So that's the dual aspect principle. We talk about local particularly developing the double entry principles, the debit, two double entry principles for us. So we'll be talking about the debit and the credit. So double entry principles rules apply in this place. So these principles so collectively form the foundation. They collectively form the foundation of accounting practice. So this provides framework preparing and interpreting financial statements for us. So when we now adhere to these principles, it helps us to maintain consistency. It helps us to maintain accuracy, reliability, transparency, and everything of financial statements. So for us to be able to make business decisions, for us to be able to make business decisions, and those users of accounting can be able to know what to do after when seeing the financial statement. So let us now go to the principle of double entry. First of all, I told you to write that one down when we talk about the asset, the accounting equation that asset equals to capital plus liability. So, and this one, which is double entry, is the basic function, is the foundation for double, is the foundation of accounting, principle of double entry. So I would like you to also pay attention, pay full attention to this also too. So double entry system is the entry of debit and credit for each transaction. There's a debit and there's a credit. There's a debit and there's a credit for each transaction. So we're going to look at examples. We're going to see, we're going to get more understanding about it. So this tells you that for every giver, there must be a receiver. That's just the double entry principle. So for if somebody gave you something, then somebody will receive it. For anything you receive, somebody gave it to you. So something that you give out, somebody will receive it. That's what makes double entry. So for every debit entry, there must be a credit entry. For every giver, there must be a receiver. Makes it double entry. Makes it double entry. And what are the golden rules of double entry? What are the golden rules of double entry? So we have that all transactions must be recorded in two accounts. Every transaction must be recorded in two accounts. Transaction means that you make any, if there's any sale, you make sale, you must have two accounts that are recorded. You made a purchase, there must be two accounts. You bought something from Jumia, there must be two accounts. You all know that every transaction, somebody borrowed money from you, there must be two accounts that must record that transaction. There must be two accounts that record that transaction. I'm just quickly walk through. So what is transaction? So that you know what is even transaction before you move to that one. So the transaction can be defined as a transfer of value from one person to another. So for every giver, there's a receiver. For every giver, there's a receiver. So it's defined as transfer of value from one person to another. So and value can be in monetary terms, can be money, can be goods, can be services. It can be money, it can be goods, a product, and it can be services. But there's a giver and there's a receiver. So it is the exchange of goods and services for money. And transaction can be divided. We have the cash transaction and the credit transaction. We all know cash transaction. The moment you just do business, somebody pay you money, and that's cash transaction. You collected your money, chicken, bye-bye, let's go. Bam. But the moment you do that business, you transfer goods to that person, and there's something in return, which is the money. But money is not coming in. That is credit transaction. You are doing it on credit. So settlement of money deferred to a specific date. So the person will pay later. So there's another account you open. So when cash is being done, when there's a cash transaction, you record it in your cash book instantly. You open your cash book, you write it there. I've sold 10. You sold 10 biscuits. Where what is there? The amount. But you sold 8 biscuits and another 8 biscuits, but there was no money there. What do you open? You don't write that in your cash book again. You open another book which is filled with journal. You write it there. This person is owing me 8 biscuits and an amount. So you're able to see and everything. So you have the sales, purchases, return inward, return outward. So which is on credit transactions. You can see those cash and credit. So these are transactions as we have seen. These are transactions. So that transaction we are now talking about, we now say that all those transactions we just talked about must be recorded in two accounts. One account is debited and one account is credited. So secondly, say for every debit entry in one account, there must be a corresponding credit entry in another account. So for when money is going out somewhere, it's going in another place. From every good that is going out somewhere, is going in another place. For every service that is going out from somewhere, is going in another place. That's the golden rule of double entry. And for every credit entry in one account, there must be a corresponding debit entry in another account. Just vice versa. For every debit entry, there must be a corresponding credit entry. Vice versa. Vice versa. So it's not the same thing we're talking about, that the process of applying that double entry. So identify, first of all, so when we say it's going from one account to another account, what are those two accounts? First of all, you need to first of all identify what are the two accounts we are talking about. So you need to identify, we are talking about going from here to here. So what are now the two accounts that are involved in that transaction, either cash or credit? First process. Second process, determine the account that gives. So if you have not now ascertained the two accounts, that one is going out, one is receiving, one is giving, one is receiving, then determine the account that gives and determine the account that receives. Determine the account that gives value and determine the account that receives. If you know that one too, wow, your accounting knowledge getting stuff, things will start getting easier for you to understand. things start getting easier for you to understand. So 3, debit. Debit the receiver and credit the giver. These are golden rules. Debit the receiver. So anything that is coming in, you debit it. Anything that is going out, you credit it. So debit the receiver and credit the giver with the value involved. And 4, debit any receipt or credit any payment. Same thing. So debit the receiver or debit the receipt, credit the giver or credit the payment. So when money is going out, credit. When money is coming in, you debit. You debit. Then 5, debit value in or credit value out. So when there's a value increase in value, something increase, something increase, you debit it. But when something reduce, you credit. When something increase, you debit. But when it reduce, you credit. So please note these golden rules. Note these processes. Note these processes. So let me say it one more time again. First of all, we talked about transactions. So identify the 2 transactions involved in, identify the 2 accounts involved in the transaction. First of all, because there's a transaction either in cash or in credit. So identify the 2 accounts. When you identify the 2 accounts, determine which one is giving value and determine the one receiving the value. Then, if you know the one that is receiving the value, debit it. The one that is giving out the value, you credit it. Then, just the same thing we just said that just so if there's an increase in value, debit, and if there's a decrease in value, you credit. You credit. So you credit. So before I move to this business source document, or okay, let's quickly move into source document. So we now look at one example. We now look at one example, some examples. So source documents, where do you get those transactions from? Business transactions and documents. So all those transactions you're talking about, this in cash or in credit. So where do you get the documents? These are called source documents. So those source documents, these are written evidence of business. You know, with an accountant, you have to be objective in what you do. Objectivity matters. So if somebody tells you he's selling it, he needs to show the evidence. Evidence. Where are the documents to back up what you just said? So these are source documents. Source documents, these are written evidence of business transactions that describe the essential facts of those transactions. It's actually we're talking about both cash and credit. We need documents to back those results. We need documents to back those results. So what are and those documents are used in preparing financial statements. So part of the source documents are receipts. You went ahead to buy something, they give you receipt. So if you tell me you bought something, you need to show me receipt. So receipt is being shown. So receipt is part of source documents. Invoice too. Don't know what invoice is. So it's part of the source document or PO, purchase order. Bank statement too. So from a bank statement, we all see the transaction that comes in, see the money that comes into your account. Someone transfer money to you, always see it. So bank statements, credit notes, debit notes, checks, or pay slips. These are source documents. These are where we can able to extract every transaction that happens for you to be able to record. Vouchers too, vouchers for payment. So these are source documents that we need. These are source documents we need. So in a double entry system, an account is a statement in which are recorded all the transactions. Okay. So before I move to it, so that I will not bore you, I just quickly need to go to for an example. Let's quickly look at an example. So before I now go to that one, so that it won't choke. So let's look at one example. So let's look at an example of a double entry transaction. Now, you started business with 100,000 naira in bank. You started business with 100,000 naira in bank. There are, based on the principles, based on the golden rule, there must be a receiver and there must be a giver. Or better still, to even understand it, let's go back to this. To understand it better, let's go back to this. So those accounts that we talked about, that there must be accounts. There must be accounts that you must know, 2 accounts that you must know, which is when we talk about this. When we talk about number 1, identify the 2 accounts involved. 2 accounts involved. So what are the accounts? Let's now talk about accounts. So accounts can be personal accounts or impersonal accounts. So when we talk about personal accounts, we are talking about debtors, creditors. Debtors, creditors. It deals with person, the debtors, the creditors, and everything. So these are personal accounts. So the debtors lien, the creditors lien, and this is when we are talking about transaction on credit transaction. So that's where this personal account comes in. The impersonal account, an account in which income and expenditure are recorded. So we have the expenses. So those accounts, we have the expenses, we have the gain, the loss, income. So anything that is expensive, rent, wages, salary, all these things, they are expensive. They are expensive. So gain, loss, which is the income, which is the revenue. So these are nominal accounts. And we have the real accounts, which are the assets, motor vehicle, land and furniture, land and building, furniture, stock, cash. These are real accounts. These are real accounts. So let's know those accounts. So these are the accounts you need to identify. So from a transaction, you need to first of all determine what account is there. What are the 2 accounts that are involved? What are the 2 accounts that are involved? So now, let's look at this first transaction now. They say started business. Started business with 100,000 naira in bank. Or let's look at this second one. Bank, you took money, you say bank cash with 20,000 naira. That means you took money from your pocket. You took it to the bank. That's the transaction. Bank cash with 20,000 naira. Or rather, we say you deposited money. You deposited money, the cash that you have, and you went to bank to record it. So what are the 2 accounts that are involved here? We are saying the transaction. The transaction is that you took money from your pocket, physical money, and you went to bank to deposit it. So what are the 2 accounts? So there's a giver and there's a receiver. A list. So please pay attention. There's a giver and there's a receiver. The person that is receiving is the bank, because you are taking that value, which is 20,000 naira. You are taking it to the bank. So there is an increase in value. Is the one receiving, the bank that is receiving it. So because the bank is receiving it, you debit bank account. So from an account that you prepare, not those 2 accounts, you debit bank account. You debit bank account. Then who is the one giving it out? It's your cash book, your own cash. So your cash account has reduced. So let's say you have 10,000 naira and you have 100,000 naira in your account, in your cash, as a cash you have, and you remove 20,000 naira from it. You can see that it has reduced from 100 to 80 by 20,000 naira. So it has reduced. Because it has reduced, you credit your cash. And because it's the one giving out, is the one giving value out, you do what? You credit it. But the bank is the one receiving it. That means there's a value in. There's an increase in value in the bank. So you debit the bank. You debit the bank. I hope I hope that is clear enough. Now, this first one, January 6th, they started business with 100,000 naira. They started business with 100,000 naira. Now, first of all, determine the two accounts in this place. They started business with 100,000 naira in bank. That means you have 100,000 naira that you want to use to start business, and you now put that money in bank. So which one is receiving? Bank. That's why you debit bank. But which one is giving out? Capital. This is no more cash gain because it's capital, because you want to start business. When you want to start business, it is called capital. That's the account. It's capital. When you want to start business, that is your capital we're talking about. When we say asset equals to capital plus liability. So that capital, because you want to start business. So it's giving out. The capital is giving out. So you credit your capital, but you are taking it to the bank. It has increased the amount of money you have in the bank. It has increased by 100,000 naira. So that's why you debit your bank account. Please, I hope this is clear. If it's not clear, please let me know in the chat box. Let me know so that we can, because these are the foundation. You can understand all this one. Anytime you see any transaction, you know how it is being posted. You even know this is where fraud is being detected, because when they know that there's a giver, there must be a receiver. And they discover that there's a giver and there's no receiver in the right way, that's where fraud is being detected. This is how EFCC they work. They know that there's something wrong. How can you say you withdraw money to, say you want to do construction of road and you're taking it out from the account, and yet the road we never see them? So what will happen? There's something. So that's how fraud is being detected. So for every debit entry, there must be a corresponding credit entry. So you understand the two accounts, where it's going and which one is receiving. So in further explanation again about this principle of double entry. So let's look at January 8th. January 8th. We have Shegun lent us 50,000 naira in cash. Shegun lent us 50,000 naira in cash. First of all, determine what are the two accounts that is involved here. The transaction is that Shegun lent us. That means we borrowed 50,000 naira from Shegun. When Shegun was giving to us, he gave us cash. He didn't transfer it to the bank. He gave us cash. Shegun borrowed us, lent us 50,000 naira. That's the transaction. From that transaction, two accounts are involved. Which one account is taking? Which one is receiving? Good. So Shegun lent is one account and is the one giving out. Is the one giving out. You can see. Is the one giving out. That means in Shegun's account, the money he has, either in heaven and on earth, has reduced by 50,000 naira. So it's the one giving out. So it has reduced the value. And lend us in cash. You don't put your name when it comes to account. You don't put your own name, because you are standing in as the business, the owner of the business. So your name is not there. So you cannot put your own self as an account. You cannot put your own self an account. But because Shegun is the other part, and you need to put his name because he's our creditor now. He's our creditor under personal account. You put Shegun. So Shegun, you credit Shegun because he's the one going out. And he gave us 50,000 in cash. So your own cash account has increased by 50,000. So even let's say you have 500 million in your cash account, in your cash, and another 50,000 naira is on top of it. It will be 500 million and 50,000 naira. It has increased. So you debit your own cash account. You debit your own cash account. Let's quickly, because let's quickly look at this transaction, because I know 12 is need to go on a break. So then let's make it faster in this aspect. Then the next one is the cash. January 14th, January 10th. Cash purchase. Cash purchase. That means you purchase something by cash. You did not do transfer 70,000 naira. You purchase something, you purchase a good, you purchase something for 70,000 naira. So it says, what are the two accounts in this? What are the two accounts? You have purchase and cash. These are the two accounts. So which one is going out? Because you purchase it by cash. That is from your cash book. So let's just put that example. You have the physical cash with you from your cash book now. You took out 70,000 naira from it. That means it has reduced. Your money has reduced by 70,000 naira. So, and the cash is giving out. Because the cash is going out, what happens? It reduces your cash and you credit it. That's the thing that is going out. Your cash is going out. 70,000 naira is going out from your cash. So you credit cash, and what you purchase, there will be a purchase account. That's another account, purchase account. You will debit it because it has increased by what you purchase. It has increased by what you purchase. So goods to color, January 12, on credit. You sold those goods, but it was on credit. You sold those goods, but you not pay money on credit to color. So what are the two accounts in this case? In this case, because you sold, an account is sales. Sales, as I said, you don't put on it. So you sold good, there will be a sales account. And to color on credit. If you do not sell it on credit, it will just, the other account will just be cash because money already coming. But because you sold it on credit, we need to know who you sold it to. You want to create an account for that, which is color. So because you make sales, your sales has reduced because the sales account has reduced by 30,000 naira. It's going out. And it's going to color. Color's own has increased. His account will increase. That means color is now owing you 30,000 naira. So that's why you debit color with 30,000 naira. So anybody that now sees an open account, you see color 30,000, you know that color is owing you. That is why it is there. And your sales, you credit it because sales is going out. Sales is going out. Though you have increased in your sales, but sales is giving out, but you credit it. Sales is going out, you credit it. Then January 14th, bought furniture for cash. Bought furniture for cash, 45,000 naira. What are the two accounts? We have cash and we have furniture. We have cash and we have furniture. These are the two accounts. I'm going to stop here. Cash and furniture, two accounts. So cash is going out because it has reduced. As you can see, your cash you have, it has reduced by 45,000 naira rather. That reduced by 45,000 naira. So your cash has reduced. So you credit your cash because money has reduced. It is the cash that is giving out value. And your furniture account is another account, which are the real account we want to talk about, has increased. That's why you debit furniture account and you credit cash account by 45,000 naira. 45,000 naira. You can take the time to also look at this. When we come back, we look at more examples. We look at more classwork. It's going to be interactive this time around when we come back from our break because we're already 12. I think we have 8 minutes break. Madam Edith or Madam Mercy, if you are there, so if you can take over from here, so we can go on for our break and come back. And if you have any questions, please, when we come back, you can always ask. Either you unmute or you send it to the chat box so we can deal with it before we go even further and further again. So, Madam Edith, are you there or Madam Edith? Madam Edith?
All right. Yes. Thank you so much for a wonderful session. So we'll be going on a break right about now, and we'll be returning at exactly 12:30. So everyone, please do not go too far. 12:30, we will return. Thank you and enjoy your short break.
All right, so I hope you all enjoyed our break so far. So now let's continue. So we won't waste much time. So from where we stopped, we're looking at the double entry. So is there any question so far? Any question? I would like to entertain that now before we now start moving to some classwork to do. Any questions so far? If you have, you can just take it in the chat box. So let me share my screen. So we're going to work together with this. So we need answers from the chat box. I will need answers from the chat box. Okay, we shall be doing this together. Just give me a few minutes. Let me, as I'm trying to have access to this. So if there are any questions so far, please send to the chat box. Trying to open the account. So, okay, 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 okay. Trying to cover this. Yeah, 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 yeah. All disabled participants. So I can't share the screen. All disabled participants sharing, screen sharing. Can grant me access to be able to share the screen. We can have access to share the screen. Since I still don't have access to share my screen, I'm trying to share the screen, but saying I am being disabled to share the screen. You can work on that. Show the screen. Madam Edith or Madam Messi, you can help me work on this.
Damola, can you make him co-host? Damola, are you there?
Hello, can you hear me clearly?
Yeah, I can hear it clearly.
I can hear you. Make him co-host, please, so he can share his screen.
I just did. Maybe my network is a little bit glitchy. I just did.
I can't see him as co-host from my end, so it's not been affected. Okay, now he's a co-host.
Okay.
Sam, you
Alright.
can now share your screen.
Okay, all right, thank you. All right, yeah, perfect. Yeah. Okay. What is it to be? Yeah, sure. Okay, good. So we'll be looking at this together. We'll be looking at this together. So, okay, I'm looking at the chat box. So, Richard, you said, why do we need accounting in our day-to-day activities? Yes, we discussed it. Our day-to-day activities, we need it. So, number one, sometimes for you to be able to manage your finance, even as a salary earner or thereabout, you need those accounting, able to manage your finance, you manage the money you have with you. So it gives you way on how to manage your finances. You know what expenses you need to cut, what you need to put more effort on, this and that, so that you won't get stranded. That's even as a so as a business owner, you also need it to manage. You're able to track your income. You track your income You track your expenses. You know you have a record, so that's why you need it. So you know how to spend money wisely. So you need all those things. So also, you need to budget. You budget too. If you're a salary earner, you start budgeting for next month salary, even though you've not collected it, but you know that this total amount is coming in. I'm going to pay for this. I'm going to pay to fees for this. I need to reduce my this. I need to reduce this. So these are the reasons why you need it. You need to budget. You need to plan. You need those things too. And with that too, you make decisions too. For you to be able to make decisions too, we talk about it, to make informed decisions. That's why you need it and everything. So as I said too, based on all the users of accounting we talked about, you need it so that even government too can know how to complete their tax, how much tax they're going to charge you based on your recording, your day-to-day recording. So you need all those ones too. And you need those things. So as a company too, they also we need it too for controls, cost control, expense control, and everything. They do those controls. And you need it ultimately for growth. For growth, you know if you are progressing or you are not progressing, you really need it for growth. So you will know. If Dangote has not been recording in all his transactions, he won't have diversified into all crude oil, or what do you call it, petrol, doing that. So because he was doing those recording and everything, and they were growth. You know, he started from, he had cement, so it was growing. It was growing. He had to now go more sugar, salt, this, that, and everything. So start doing it. Thank you for refinery oil and gas and everything. So he's expanding. He's expanding. As he has done this one now, who knows next? Maybe his next thing is going to go and buy Arsenal because he has interest in buying Arsenal as a club. So he started expanding and expanding and expanding and expanding. But if his business was deteriorating, if his business was nosediving, those business you will not be hearing of all those businesses. Spaghetti, everything Dangote. One day they would Dangote live, but everything we need is just going to be Dangote. Your food, rice, Dangote, everything Dangote. So because of growth and everything. So you need to have those records doing those accounts. So it's for growth. And to also prevent fraud, if you have somebody you put as if you have one side hustle, it's so now. If you have side hustle and because of your own day-to-day activity, you have to employ someone to be there. So you will have to tell the person to always have records. So you need to detect if this person is fraudulently taken out of your money or not. So you need all those things too. And you need for record keeping and for comparison. So that's the reason why we need it. That is the reason why we need this record. So I hope that is very clear. So it's very important. Not only as a business owner, you need to record. Even as an employee, if you're collecting salary, even as more money is coming in, you also need to always have record. Have record of everything. Have record. Because, as we say, human wants are inattainable. So the limited money that comes in, you need to budget for it so that you won't get stuck, you won't get stranded. Savings, as you always say, save first, they know how to manage the expenses so that in case of unforeseen circumstances that might occur in the future, you have something you invest for the future so that when you grow old, when you are no more, you are no longer capable of working again. It's what you've saved, you've invested that will now work for you. That will now work for you. So that's the reason. So let's now go to our classwork. So I will all lead us to, so from our chat box, just so let's give answers to this. So the principle of double we are talking about. Here are transactions from A to H. So we say bought furniture by check. Bought furniture by check. What are the two accounts here? I decided to just block these so that we won't see the answer there. So I just want to, so let's know we are together. So no answer is wrong. No answer you are wrong and everything. So you are all learning together here. I might even be wrong too, but so you're all together. So nobody knows it all. So here's the transaction here. Brought furniture by check. This is a transaction. Is it a cash transaction or a credit transaction? Obviously, this is a cash transaction, even though it was check. It was not credit. So is more or less like a cash transaction or check transaction. Check and cash is almost the same thing. So what do we say here? It's a cash transaction. Yes, thank you, Richard. So I'm opening the chat box. I'm opening it just before me. So let's start participating. So what are the two accounts here? First of all, what are the two accounts here? We need to first of all determine the account. As we know, we say they will always determine the two accounts. Determine the two accounts that is involved in transaction, because for every debit entry, there will always be a corresponding credit entry. For every giver, there will always be a receiver. That is it. So what are the two accounts in this transaction here? So I'm waiting. So okay, it said credit, debit, and then yes, no, yeah. Good. Okay, Rashid just got it now. So I'm looking at Richard. You said credit and debit accounts are the two. No, account is not with debit or credit. So account, so I said based on what. So I believe that the slide will be shared to you after the end of the class or something like that. So, but we have all those accounts. Now, as I said, we have the personal account and we have the impersonal account. That impersonal account, we have the nominal and the real account. So the personal accounts are the creditors, the debtors, which is the supplier or the customers or that, but when it's on credit. And we have the real account. We have the real account. We have the nominal account, which are the wages, the salary, you open wages account, you open salary account, you open even sales account, profit and loss account, all those ones you open it. And we have the real account, which is the fixed asset. We have the furniture account, the plant and machinery account, motor vehicle account, these accounts. So all this from the personal, the nominal account, we have the capital account. So all those are accounts. So you have to check all those accounts. If it is a creditor, somebody that we borrow money from, you say the name, Kola, Shegun account, this one. If somebody that we need to pay, you open that person, the name of that person. It's just like it's your own name that will not be there. You as a person will not be there. So your own is either like cash or check or this and everything. That's corresponding. So let's make that one clear so that you understand. So when you say credit or debit, that's another account. But it is what you credit. It is the account you have to credit or what credit. And I said debiting. Crediting means something that is going out. Something that is going out or something that is reducing in value. While debit is something that is receiving or something that is coming in or something that is increasing in value. So you get that. Debit is something that is coming, something that is increasing in value or something that is receiving. While credit is the opposite, something that is going out, something that is reducing in value or something that is giving. So I hope that is clear. So for this first one now, which is bought furniture by check. Bought furniture by check. So Rashid said furniture and bank. Good. Furniture and bank, that's very good. So you can see these are the two accounts. Furniture and bank. Though you cannot write check. Who makes use of check is bank. So you just put bank. So because check is for bank. It's just that the money, they are not collecting the physical one. So it's now be the transactional, the electronic one. So, but just you are not more, nobody. So check is phasing out very soon now because of the advance in technology and everything. Just make your transaction on your phone, and that's all. Get your token, and that is all. Token is taking over. So the two accounts involved here now is the furniture and bank. These are the two accounts. You've gotten that pass mark. Now, second stage, which one is increasing in value and which one is reducing in value? Or which one is receiving or which one is giving out? So I need to know that too. Yes, on the chat box, on the chat room. Which one is receiving or which one is increasing in the value and which one is going out? Okay, Rashid, you said debit, furniture, and credit bank. I hope you all agree. Please, if you don't agree, let me know. If you don't agree with me, let me know. Let me know if you don't agree. Just say I disagree. If it's correct or wrong. If you all agree, let me know. Let me know. Okay. So no. So yes, Rashid, you are right. So as you can see, you are debiting furniture and we are crediting bank. And why? Why is that? Here's the reason. So you say you bought furniture. Let's say you have 10 furniture already. Let's say you already have 10 furniture. And you now bought more. You bought 2 more. You know your furniture has increased from 10 to 12. It means it has increased in value. That account has increased. So it has increased. That furniture account has received, has welcomed 2 more furniture. You are welcome to our class. You are welcome to our class. Has received 2 more furniture from the 10. You are join the 10. So it has increased. Because of that, you debit your furniture and your bank, which is the check, the money that was there has reduced. The money that was there has reduced. That's why you credit bank. So if you're a good auditor or if you're a good EFCC and somebody now gives you this, these are things you look at. This amount reduced in the bank. They said they want you to go and buy furniture. Where is now that furniture? I now scan. You didn't see the furniture. Oh, you know there's a fraud. That's how you know there's a fraud. That where is the furniture? We need to know where that furniture is. You said you use money for furniture. So where is the furniture? So you know. Even if that person not even get that furniture, now listen, if that person not get the furniture, and you now see the amount, and you see a furniture that's supposed to be 5,000 naira is now about 50,000 naira. There's something wrong again too. So you detect. So this is the reason why there's always a record. You detect fraud and everything and something like that. But even if it's not fraud, this is too much. So we need to reduce it. We need to try and look for another customer or look for another supplier who can give us a reduced price. So it won't affect our profit for our profit. So these are the things you need to record to make informed decisions and everything. So you're right. You debit furniture and you credit. You debit furniture. So I'm trying to open it so you can see that you're right. You debit furniture and you credit your bank. That is correct. So 100 marks for Rashid. Now, second one, receive commission by check. Oh, yeah, let's see. All of us, please, all of us, let's try and do these things too also. Let's try and work on this. So this would let us know that we're getting it. Even if you don't get it, we're explain further until you know about it again. So receive commission by check. That's you receive commission by check. What are the 2 accounts here? The 2 accounts here that we are talking about. What are the 2 accounts? Let's be fast. Let's make it snappy. What are the 2 accounts here? What are the 2 accounts you're talking about here? Anyone? I'm still waiting. Anyone? If you don't know that one, let's go to number 3 so that we won't waste time. So maybe you are thinking what's going on in that based on commission, big English, or thereabout. So let's go to see. If you see, you can just put the C and let me know that it's C you are talking about. D is the D you are talking about. If it's C is D you're talking about. So I'm put either debit or credit here in it. Either debit or credit in it. So let's talk. So receive.
Samuel, people are putting their comments in the chat room actually.
Okay. Maybe it's taking long to drop here. I'm already seeing. Okay. I'm Rashid. System Rashid. Okay, good. So as you're putting it down, you're good. That's very good. Commission and bank. These are the 2 accounts. You can see these are 2 accounts that affect that transaction. Commission account and bank. So which one is receiving and which one is giving? I'd like you to put the debit and credit before each account. Debit and credit before each account. So I need to know that. So Richard, you said personal and personal accounts. No, personal, these are just like a class. It's a class of accounts, not really the exact specific. So you need to be specific of the personal account and personal account. So So we need to, so we are going to specific. So we are only using a general word in personal account and personal account. So we have to be specific now and everything. So let's be specific. The specifics are there in the transaction. They are there in the transaction. The specifics are there in the transaction. So Rashid, you're right. So the debit bank, because you receive and you credit commission, you're right. So as you can see, so if you can see that B, he said you receive commission by check. You receive commission. So from your commission account, if you have 10 naira in your commission account and you receive more, it means your commission account has increased. And somebody paid you check. It means that person, that bank of that person, which we don't know, that's why we just put it bank as reduced. So bank is reducing, is the one giving out. Bank is the one, oh, sorry. Sorry, I was looking at something. So it is debit bank and credit commission. That is it. It's debit bank and credit commission. You're right. You debit bank and you credit commission because your bank has received. So your bank has received. So you debit bank and you credit commission, which is it? Which is it? So you can see you debit your bank because you receive commission by check. It has your check as your bank has increased because it went to your bank. So you should know that. So C, we say paid wages by cash. You paid wages by cash. You paid wages by cash. Paid wages. You paid someone wages by cash, or you paid your employee, your laborer. You pay them by cash. The two accounts that is being affected are what? The two accounts affected are what? The two accounts affected are what? Wages and cash. Good. Wages and cash are the two affected. So which one are we debiting and which one are we crediting? Which one are we debiting? Which one is receiving? Which one is receiving? Which one is increasing in value? Which one is increasing in value? Which one is increasing in value? Good. You debit wages and you credit cash. You debit wages and you debit cash. Fantastic. So you debit wages and you credit cash. So you see, because when you paid wages by cash, your own cash has reduced because money has gone out from the ones you have. Money has gone out from the ones you have. The money you have in your account, money has gone out. So you now have to do what? You now have to pay. You now, if you reduce your cash, then your wages, the account of wages will increase. That means you are paying more wages now. You are paying more wages now. So that is what it means. Then the next one is cash sale. Cash sale. Cash sale. Cash sale. Yes. Cash sale. Yes. Cash and sale. That's it. These are the two that is being affected. Cash and sale. So, which one is to be debited and which one is to be credited? Not seeing other one. Richard just, okay, I guess it must have been left. Okay, Richard is back. Okay. So Richard and the rest of the all of that, please let us try and just comment, just send your chat box and everything. Let us not just leave it for just three of us. So let us all work together. We will understand this. So it's something you can understand very well. You will understand very well. So cash sales is cash and sales. So you say yes, debit cash and credit sales. Good. So when you make sales, money comes in, your sales reduces because the goods in your is reduces. So the sales reduces, even though automatically it increases, but because it's going out, it is sales that is going out. So what happens? You credit it, but the money is coming in. Your cash will increase. Your cash will definitely increase. So when you make sales, your cash starts increasing. Your cash starts increasing, or your bank starts increasing. So it's not that. Cash purchases. What about cash purchases? What about cash purchases? Cash purchases? Cash purchases? Yes, cash and purchase. Good. Cash and purchases. So what now happen? Which one are you debiting? Which one are you crediting? Which one are you debiting and which one are you debiting? Remember, you purchase something by cash. Something has reduced. You've known. So looking at your cash, what will happen to your cash if you purchase something? Will your cash increase or will your cash reduce? And what you purchase, has it increased in value or reduced in value? Fantastic. So good. You debit your purchase, you credit your cash. So it's just the opposite of cash purchases. Cash purchases and cash sales, they are more or less like what an opposite. So when you debit cash in one, you credit cash in one. So that is it. So you debit your purchase because since you purchase something, your purchase account has increased in value. It has increased in value by that amount you use to purchase it. It has increased in value by that amount you use to purchase it. And the same thing to apply to cash. It has reduced by the amount you use to go and purchase here. So started business with open it already. Started business with money in the bank. We treated that one before. So started business with money in the bank. What happened? Because we say this is the money you want to use to start a business. You already have it. You want to use to start a business and you put it in the bank. So your bank has increased. You debit your bank. Why your capital? The capital is the one giving out. So sometimes you might be thinking, so that's why I use three. Which one is giving out and which one is receiving? Or look at it in this way. Which one is increasing in value and which one is reducing in value? So you must know that. You must know that. So that is how it is. That is how it is. Then sold goods. Okay, let's look at this now. So this is another different one. G. Sold goods on credit to Mr. President. Sold goods on credit to Mr. President. What are the two accounts here? 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 Let's look at it. What are the two accounts here? Okay. Okay. Yes. Okay. Yes. It says sales and both Mr. President. So which account are we debiting? Which account are we crediting? Which account are we debiting? Which account are we debiting? Because of time, let's quickly we can see because of time so that we can quickly rush it so that we won't because we have a whole lot cover. So go on credit to Tinubu, you can see. So Tinubu is the one receiving, then our sales, because our sales is reducing because the sales is the one giving out. Sales is the one giving out, while Tinubu is the one receiving. So that's why it's happening. If it was cash sales, if we sold the goods on by cash, not on credit, then it will just be cash that will be there. So the same thing as cash sales, because it was credit, it will now be sold on credit. Credit sales. Cash sales, credit sales. Because of credit sales, let's know who the person is. Personal account. Let's know which person is Mr. Tinubu. Then brought generator on credit from Dangote. Brought generator on credit from Dangote. Your generator has increased because you want receiving, and because you are owing Dangote. If you have bought it in cash, there's no need of putting Dangote there. You just our cash is just reduced. But because we bought it on credit, so let's put Dangote there. So we know that we are owing Dangote this amount of money. You know we are owing Dangote this total amount of money, and we now be looking forward on how to pay back. So these are the principles of double entry. Principles of double for every transaction, for every debit entry, there is always a corresponding credit entry. For every giver, there must always be a receiver. So that is the foundation of account, and these are you need to always record. These are your honest record. So when you have some money with you, and you went ahead to go and buy goods at the market, your money you have in your bank will reduce. Why the goods you bought has increased. So when you now start selling, those goods start reducing. Why the money start coming back again? Because you are start selling what you purchased, start coming back and increasing and increasing. And from there, start knowing, am I making profit? Am I making loss? Am I selling in the right am I selling the right amount or not selling in the right amount? The reason why we all need to have accounting have records for all our transactions. So let's go back to our slide. Let's go back to our slide. So I guess that is clear for us. So all other ones are there, so which you can always look at. So good, you see. So good, you see check 55,000 when it's so good, so if you reduce your sales is giving out the credit to. Or since it's so good, money is coming in through your bank, that's why debit bank and the like. So that's what we have for that. Then, so we have double entry rules can also be applied in this way. So it can also be applied in this way. Debit asset account, when there is an increase in value that is hammering on. So debit asset, when it comes to asset, anything asset, we all know our asset. This more is like an expo kind of thing. Anything that is asset, our either fixed asset or current asset, not as much as asset, land, building, motor vehicle, plants and machinery, generator, your cash, your bank, all these ones, your treasury bill, or these are assets. So debit asset account, all this when I talk about the generic, so which is the real account under in personal account. So debit asset account when there is an increase in value. When there is increase in value, so when one asset is bought, increase your stock or anything, just debit it. But when it reduces, that means when you sell that thing, that's when it reduces. You credit it. That's what asset. For expenses, you debit expenses account when there is an increase in value. When there is increase in value, for example, your wages, salary, these are expenses accounts. There are those nominal accounts. So you increase when there is increase in it, your debit expense account when there's an increase in value. So you pay salary, it has increased. You employ 3 more, and you pay salary. You know that salary account, it has increased by the number of employees, the 3 employees you employ. Their salary is correct, it has increased. So when there's increase in expenses, those debit it. But let's say 4 of them now left resign, your salary will reduce. So their amount will reduce by the salary you are paying for them. So you credit it when it reduces in value. When it reduces in value. Then when it comes to liability, credit liability, creditors and everything, anything creditor or liability, call it basis, or maybe even if it's your capital too. So credit liability and capital account when the value increases. Okay, we say credit liability and capital when the value increases, then debit when the value decreases. So when the value decreases, you know that your liability when the value so you credit it when the value increases. When the value increases, know that. So when you borrow, this one is just telling you that when you borrow money now, because liability, you borrow money. You know, if that person pay you in cash, your cash will increase. But your cash will increase, but you will debit it. The same thing, your liability has increased, but because it's the liability is negative, but it will not be credited. It means that you are owing more, even though there's an increase. But because you are it's a basis, it's an owing. So you have to credit it. You credit it. But if that liability has now reduced because you have paid part of it, it has reduced. So you debit it. So what you paid, now you paid it from the cash you have received. You pay part of it when you are owing. So your cash will reduce it, or your bank will reduce it, while your liability also reduces to credit it. So notice you have assets and expenses. They are using the same double entry rule, while liability and capital and different rules. So note it down so it helps you in knowing how to post. To know how to post which one to be on credit side and which one to be on debit side. So let's look at these two. We are looking at capital and revenue items. Capital items and revenue items. I want to believe these shouldn't be you should be familiar with this when you're talking about capital items or revenue items. So we'll be talking about capital expenditure and revenue expenditure. So if you are so conversant with what do you call it, government budget, we always see that it's being divided. Their budget. You see capital expenditure. When you look at the expenses, you see there, these are the expenses we want to talk about. These are the expenses we want to do. These are capital projects. These are capital projects. These are capital expenditure, and we have revenue expenditure. So what are capital items? They are long-term assets or investment that company purchase. They are long-term assets that the company purchase or they invest. You know what? In order to generate income over an extended period. So it's always going to be more than 1 year. So they are capital items. They are even items that involve huge amounts of money. They involve very huge amounts of money. And that's going to be that lasts more than 1 year. It's going to last more than 1 year. So it's a long-term asset or investment. Asset or investment that company purchase or invest in order to generate income over an extended period. So these are items that are not meant for immediate consumption. You don't consume instantly. So something that you consume instantly, it is not capital. It has become a revenue item. It's become a revenue item. So note that. So it's not for immediate consumption. But they are expected to provide benefit for a prolonged time. For example, we have acquisition of land. These are capital items. When you acquire land, because you know that land, maybe you're going to build an office there or a house or thereabout to start your business. It lasts for more than 1 year. So they are fixed assets, new fixed assets, tangible assets, non-current assets. So building, machinery, equipment, these are capital items in the books of a company. These are capital items. Improvement of an asset. Maybe a building, you want to extend it by another story building, you improve on it. So by adding value, if it is just a story building, you increase it again because you are increasing. It's different from when you are painting. Painting is just maintenance, which is not, it won't be recorded as part of, it won't be recorded as a fixed asset. But when you now maybe you break another, you want to make a two-story building, then you completely change that face of that asset by adding more value to it. So these are capital items and everything. So in case of any capital of business, intangible assets like patent, copyright, trademark, and all that. So in the books of companies, in the books of a government, in a book of government, when it comes to these capital items, building of roads, Lagos, Calabar road is a capital item. That is about 17 trillion for it to be as a budgeted for it. 17 trillion. Lagos, Calabar, all those roads, schools, bridges, and everything. So these are capital items or capital expenditure, as you can see, the capital expenditure. So what is now revenue expenditure? Revenue items. What is now revenue? What are revenue items? So revenue items are the day-to-day activities, day-to-day expenses, day-to-day income, day-to-day, all those day-to-day generated by a business when they are doing their operation. So they are typically related to companies' ongoing activities. So different from the capital items. So revenue items are consumed or utilized within a short period of time and contribute to the company's immediate financial performance. So when you're talking about revenue items, so which we see sales, revenue sales, you make day-to-day sales, day-to-day sales, day-to-day sales, all those ones, maintenance and repair. So these are revenue items. So that's our revenue expenditures. So revenue expenditures are expenditure incurred in the day-to-day consumption, in the day-to-day running, in the day-to-day run of the business in a period of time. So that's revenue item. So revenue item, you can have revenue expenditure, which we have talked about, revenue expenditure. So maintenance and repair, depreciation of assets, all those ones. Expenditure on day-to-day administration, paying your salary, paying your wages, this and that, paying supply, office supplies, utilities, or thereabout, toiletries, all those operations. These are revenue items. These are just day-to-day. Day-to-day. Why is it different from capital? This is different. That is why sometimes look at the budget of the state or thereabout. When you now see that the budget is also amount, the budget 100,000. Let's say the budget for the year is 100,000, and they will tell you that 100,000 naira that are budget, maybe 30,000 naira are going to get it from tax. Maybe another 30,000 naira is going to be internally generated revenue from all other things that the government will generate, which makes it 60. What about the remaining 40? There's no other way. Okay, then I say they're now going to borrow. Reason why sometimes you see government borrowing from IMF, because when they have a budget and they now say from this our budget, for example, we're having a budget of 2025 is about 47 trillion. For Nigerian budget for 2025, 47 trillion. What are 47? How will they generate that money for 47 trillion? So part of it, they know that okay, custom, we generate this total amount from custom, from tax, FRS, we get this, from crude oil, we get this. There will be left a balance. How do you not get those balance? Then that is when they now look outside, getting loans from IMF, getting loans from World Bank, getting loans from African Development Bank and everything. So all those loans, they get those loans. So it is to be sure that budget at the end of the year, the budget and the activity will concern down to say the budget and everything. So I guess you understand what I'm saying. So they get those things. So when you now see government borrowing loan, every time borrowing loan from China, borrowing loan from this, you know that it's because of the budget for the year. There's no way they can able to fund all the expenses fund all the things, so they need to go and borrow money from outside and everything. And mind you, if you are borrowing loan and you are not using that same loan to pay salary, revenue items, because that loan you are borrowing, it should be for capital items. It should be for capital items, because when you use that money to do capital items, it means that the money will come back to you and you will be able to pay back to your creditor. You're able to pay back to your creditor. So you borrow loan from IMF and everything, and because of that, you use to tie road, construct bridge. As you do those things, economy of that area will boost, will boom. You start collecting tax. Or you tie road, put vehicle on it, start collecting money, the transportation, money comes in. So you do rail, or use that same money you borrow, you used to do rail. You put train on it, start collecting fee, transport fare. You will be able to pay back. You get. But when you now use that loan you borrow, which is what is happening in our country, you now start using to go and pay salary. Or you start using for this year, those who travel expenses. How will you pay back? How will the money come in? How will the money come in? That is where you know, so when you are collecting, when you are borrowing loans, you need to know what you are spending it on. It's very important that you know what you are spending on. You don't spend it on, you don't go ahead and collect revenue loan and start using it on revenue expenses. If the revenue expenses, that means you will kill the business, because you will not be able to pay back. And when you don't able to pay back, the health of that business is jeopardized, and it could affect the business going confined to that business. Because if those creditors now decide, okay, we want to collect our money, you now start selling all your fixed assets just to be able to pay back, and it affects the business. With that, it affects the business. So it's very important that we know all the capital items and revenue items. Let's know capital items and revenue items. So expenses on this, the administration which we have talked about and everything. So let's know the difference. Capital items, these are fixed assets you make, so roads, bridges, and everything, or buying land, these are capital items. While revenue items are the salary, wages, and everything. So that is for that. Now, books of original entry. Books of original entry. Remember that the transaction, you get all those transactions from your source document. And all those source documents are gotten from your bank statement, from the receipts, the vouchers, the receipts, the invoices, the purchase order, and all other things that you can able to get transaction that happen, so for you to record. So same thing now have. So from there, then you have the books of original entry. It's also known as the primary book, the first book, the initial recording, where recording starts first. That's what we're talking about. So there are books where the initial recording of financial transactions take place. So those books serve as the first point of entry of various transactions before they are summarized and classified into the general ledger. So immediately you get all those transactions from your bank statement, from the receipt you got, from the PO, from the invoice. The first place you record it is from the book of original entry. Is the book you record it from into the book of original entry. And the prime purpose of this is just to systematically record transactions as they occur. As they occur, you record it. You record it so that you maintain an organized and detailed record of the company's activity. So you don't miss one. You don't miss one or the other. Else, your account may not balance. Your account may not balance. So what are now the books of original entry? What are the books of original entry? So you have your cash book. As I said when we're doing those last work, all these accounts we open. All these accounts we open. Record, so you open your cash book. What does cash book do? Just record every transaction that involves cash. If it's cash, just continue to record it. As money is coming in, record. As money is coming out, So as money coming in, on the debit side of that cash book, you start, as money coming, you just put it there. On the debit side, you'll be putting it there. As money is going out, you put it at the credit side. As money is going out, this on the credit side of your book. So note that debit side is always at the left hand side of your book, while credit is at the right hand side of your book. So if money is coming, you make sales on your cash book, you write sales. I made sales of this amount, 10 naira, you put it there. You made another sales, because you put date, you put it there at the debit side. As money coming in, you at the debit side. But as money is going out, I paid transport. I enter transport, so put it there. I pay somebody wages at the credit side, you put it there. So as you're putting it there, so this is how it works. So cash book records, cash book records all cash transactions. So your cash receipts, your payments, so cash, all cash transactions. So when it now comes to the credit transaction, that's when we're now talking about sales and purchases journal. So sales journal records all credit sales transactions, credit sales. You made those sales, you didn't collect money. The person cannot pay yet. So you open your sales journal. You open your sales journal. That's another book. That's when you say when account bookkeeping is recorded, something is recorded in a chronological manner, in systematic manner, in a classified manner. You are classifying it. So this is for cash, this is for sales journal. So when you open your sales journal, you just know instantly that this person is owing. You just know this person is owing you from the sales journal. Sales journal, Tower is owing, has not yet paid for this also good. You put the amount. Segun is owing us 5,000 naira. Has not paid on your sales journal. And the moment that person pays, you balance it back. You do the double entry. You balance it that has paid, and because of that, it will increase your cash. You now record it back. So there always be debit and credit, debit and credit, debit and credit, receiver and giver, receiver and giver. Purchases journal also record all credit purchase of goods. Sales is sales of goods on credit. Purchases is purchases of goods. What goods you purchase, but you have not paid them. You purchase, you have not paid them, so you put it there. Then the general ledger, which are all other ones. All other ones. Your salary, your wages, your electricity, your utility, your all other ones. So record non-routine or adjusting transactions that don't fall into specific categories of other sales or purchases or thereabouts. So that's how we record. So this is the first line of recording. First line of recording. So book of original entry, as you can see. So journal. So journal, this is another book of prime entry into which financial transactions are chronologically entered on a daily basis and then classified into debit and credit. You can see the format of how journal looks like. Date, particular, we talked about that transaction itself, then debit and credit. Date, particular, debit, and credit. So it serves as the initial entry point into the accounting process, where transactions are recorded before being transferred into the general ledger. So it's from the day book, it's entered into the journal. So account to be debited, which we just did. The examples we did, which is just did. So account to be debited, cash sales, write it there. You put the amount. The other one, you put the brief, then you do the brief. The brief would be under it. And it all goes to this social person, and this is this and that. So that's how it works. So classes of journal entry, we have the simple entry, we have the compound entry. As one account will be debited and another account will be credited. As what we have done are just simple entries, debit and credit. Just two accounts. Sometimes in one transaction, you can have 3 accounts in just one transaction. That is compound entry. You can have 3 accounts. You have several accounts. So when you debit this, you now credit this, but the same amount as both debit and but just that the transaction, the accounts are now more than 2. The accounts are more than 2. So one account will be debited and several accounts debited, or several accounts will be debited and one account credited. or several accounts, both debit and credit have several accounts, so you make it compound. But majorly, most of the time, it has always been simple entry, one account and the other account. So that's what it is used for. Then we use it, why? So to correct errors, double entry transaction, recording of total of fixed assets, purchase of assets and credit. So these are the uses for recording, acquisition of new businesses, and the like. So you can see uses of ledger, which is uses of journal. Same thing applies to uses of ledger. To a ledger, a ledger is a fundamental book used in accounting that organizes and summarizes all transactions in a business. It contains several accounts for each financial element. So all these things you are now getting familiar with, which we've been talking about. So it goes from journal to ledger. So it goes from journal to ledger, having your ledger account. You have the personal account, and as you can see, comprises the supplier. We have said the personal account. Those are personal account we talked about that time. Personal accounts and impersonal account. So when it comes to personal account, we are talking about the suppliers, the customer, and everything. So this comprises the customer, the personal account, and customers, suppliers, personal account, and customer personal account, and everything. So which is divided into sales and purchases. You know that already. Sales and purchases when it comes to personal account. Sales and purchases. Then the general ledger are the expenses, the assets, the sales, the income, and thereabout. So that's what we have. And the private ledger, in order to ensure privacy, capital accounts and drawings are kept in the private ledger, which is not really that common when it comes to a big company. And here is the format. Here is the format for a ledger. This is how it looks like. It is divided into two. Now see the debit side, as I said, the left side is the debit side, while the right side is the credit side. And both will have dates because we need to know the date of that transaction. And talk about particular the transaction itself. Portfolio sometimes always made with this number, can give it a reference number or a serial number or thereabout. Then the amount, what amount are we talking about? So this is how it is. So debit is abbreviated to be DR. Credit is abbreviated to be CR. So when you see some books, when you see CR, when you see some financial statements, you see CR, you know it's credit. When you see DR, you know it's debit. And I said that you debit receiver and you credit giver. So debit side is value, the credit side is value. As I've given an example of the cash book that we talk about. So that is for that. Then now trial balance. Trial balance. So as you can see, it starts progressing. It has left bookkeeping. We are no more in the stage of bookkeeping. We are now going to real accounting, systematical way, and everything. You get the source, your transaction from all the sources, you write it in your ledger, in your first book of brand entry, write it in your journal. From your journal, you can see that you put it in your ledger. From your ledger, if from your ledger you extract those things and you now post it in your trial balance. It's now being done in your trial balance. So what is trial balance? It's a statement that lists the balances of all the ledgers. So because from your ledger, there will always be balances. There will always be balances. So you now list them out. You start listing them out because you make the balance. After you do the debit and credit, you balance it at the end of the month. If you are doing a monthly account, you balance at the end of the month. It's a yearly account. You balance it. So at the end of the month, at the end of the year, how much sales do we make? That is what journal will tell you. And you now transfer it to trial balance here. At the end of the year, if it's the account you want to give it for you, how much wages have you paid? How much salary have you paid? You transfer it, place it in this trial balance because it's more balanced. For every debit entry, there must be a corresponding debit entry. So which one? The one that is in debit side will go to the debit side. The one that's in credit side will go to the credit side. How much are we owing? Since we pay some, so how much are we owing? left at the end of the year to be pasted in the trial balance. And at the end of it all, when you now calculate your debit side and your credit side, you must have the same number, you must have the same figure, you must have the same amount. If it does not have the same amount, then something is wrong somewhere. Something is not balanced. That's what it shows. So this is what that trial balance does. So it's a statement that lists the balances of all the ledgers that we showed you, all the ledger accounts, at a specific point in time. If it's monthly, you want to be doing your account, based on a trial balance, you know. To do what? To test the arithmetical accuracy of that account. You have to test it if it balances, if the balancing is balancing or it's not balancing. So we need to test it. So that is what it is for. That is what it is meant to do. So it tests the accuracy, arithmetic accuracy of the account. So it ensures that the total debit equals the total credit. The total debit must be the same thing as the total debit. I'll give you a very simple example. You want to go to a co-market and you have 50,000 naira, you want to go and buy clothes and everything. You are going with 50,000 naira. I now went to Island to Eco. You bought sneakers, you bought shoes, you bought this, you bought that, and everything. And when you now came back home, you now want to do the account. Okay. From this 50,000 naira, I bought sneakers, this amount. I bought this shoe, this amount. I entered transport, this amount. I am now left with this. When you now do the calculation, you now discover that this thing is, there's still something that is missing. That's what our balance does. So because you need to balance, okay, now check, I went with 50,000 naira, but I'm coming back with 5,000 naira. That means I must have bought something of 45,000 naira. But from your calculation, what you bought was just 40,000 naira. And you are left with 5,000 naira. Where is the remaining 5,000 naira? So you start thinking, did it lost? Did I buy something that I can't remember? That's what our balance does. So that every debit entry must balance with the credit entry. So serving as a preliminary check for error, to check for error in accounting record before creating the main thing, the baba of them all, the financial statement, which is the P&L, profit and loss account, and the balance sheet. So you check for those errors. So if there are no errors, then you go ahead to do the financial statement, the P&L, the profit and loss account, and the balance sheet. What are the nature of trial balance? Trial balance as column for particular. Let me see if I have the, okay, so here is it. So this is how trial balance is. So which is how trial balance is. It says trial balance as column for particular debit and credit side. So you can see particulars, or we have asset, liability, capital, and entry. So this is just generic. So you just know that all assets, all is at the debit side, all liability, credit side, all expenses, as I told you, when I told you that expo, so any asset, because when there is instrument, when there is a purchase of assets, it will always be at the debit side. Expenses too, when there's increase in expenses, you are paying more salary, you know, something like you are paying more wages, you are paying more electrical, in your trial balance, it always be at the debit side. While liability will be at the credit side. Capital or equity, which is the same thing, will be at the credit side. And at the end of it all, it has to balance. Sales or income will be at the sales or an income will be at the credit side. That means that will tell you that asset and expenses debit side, while the rest credit side. So these are the typical template of a trial balance. Typical template of a trial balance. So in preparing the trial balance, the rules must be followed. These rules must be followed. That's this is the rule we are saying. Assets, debit, expenses, debit. But liability, credit, capital and equity, credit, sales, credit. That rule must be followed. So purpose of trial balance, provide a comprehensive list of all accounts. It will provide all the list of all those accounts, those transactions, to provide it. To show the arithmetic accuracy of the entry in the ledger, to show it. To provide data for the preparation. It will provide the data, what we need to prepare our trading profit and loss account and balance sheet. So all items with the credit balance in the ledger will be credited. So as you can see, all items with the debit balance in the ledger that we're taking to balance sheet will be on the debit side of the trial balance. All items in the credit balance of that ledger will be put in the credit side of the trial balance. And at the end of it all, the total debit must be equal to the total credit. That debit must be equal to the total credit. Then there are some things that will not even affect trial balance. There are some things that will not even affect trial balance. Even though it's balanced, but it will not affect trial balance. There are some things. So error not disclosed by trial balance. So for example, if you completely omit a transaction because there was no debit, there was no credit, so your trial balance is still balanced, although you've omitted a line of transaction, a whole line of transaction. So sometimes it will not even show. You will not quickly realize. So trial balance is prepared purposely to show arithmetic accuracy, which we talked about, is to show that is the main to show it. But two sides, debit and credit, must be equal. But if otherwise, then there is an indication of error, good, which you have said. If otherwise, there's an indication of error. But in some situations, these are errors which may not even disclose in the trial balance. And there were errors there, but it will not disclose. So these errors are referred to errors that do not affect trial balance. Errors that do not affect trial balance. That's what it is. So what are the errors? What are the errors? Number one. I hope you can still hear it. Message box. I hope I'm still talking. I hope you can still hear
Yes,
me.
you are. Yes, yes, we can hear you.
Good, good. Thank you. Okay. Okay. So number one, error of original entry. Error of original entry. Error of original entry. So what are the errors? How can we explain this error? This error occurs when, for example, you can see, for example, why it not affect trial balance. For example, you have a sales of goods, 65,000 naira. Sales of goods, 65,000 to Toby, was entered into an account as 56,000 naira. There's an error of the original amount because you debited and you credited with the same amount. So because it was an error, you will not know it was an error because your trial balance is still balanced. Your trial balance is still balanced. So that's what we call error of original entry. Error of original entry. So trying to look at something. So that's for errors of original entry. So because of our time through, I'll quickly brush. Maybe we just stop at this error errors that does not affect trial balance. So I know because when it comes to accounting, these are things at the initial stage start to get interesting. But when you start entering into it, you now start seeing that all these things need to just know. For what you just have to be, you just have to be resilient, you just have to know all these things so that it will not affect your business. So that's error for original entry. That's when this error occurs when a wrong amount enters on the debit and the credit side, both wrong amounts. Instead of it to enter 55,000 naira, you enter 56,000 naira. Secondly, errors of omission. That means you completely omitted the transaction. These occur when the transaction is totally omitted. You didn't remember to record it. So it will not affect trial balance at all. We have the error of commission also too. Error of commission. That means the amount you are supposed to give, you are supposed to record when the two accounts. Purchase of goods, 10,000 naira. So you supposed to record it to Bayo, Dayo. You mistakenly record it to Bayo. All these things will not affect trial balance. All these things will not affect trial balance. With all these errors, it will not affect trial balance. Error of principles too. Also, error of principle. It says this occur when transactions are entered in a wrong class of account. So when you have recording a capital item in an expenses. So for example, capital items, which are capital items like furniture. Instead of it to open a furniture account, if you don't open a furniture account, you're going to put it in another account because a wrong class of account. So it will not affect it because your balance is still balanced, but the amount is still there, but it was an error. It's just like a wrong class of account where that's where you went ahead to post it. The compensation error. So I'm trying to ensure that we finish by at least we need to finish by 2 because we still have lots to cover up. So and when it comes to account, it's not something you want to rush. You want it to just digest it little by little. You take it as public and digest it little by little for you to be able to understand. You do practices, you check questions, and you will be able to get it. Compensating errors. So when errors of the same amount are posted through the two sides of the ledger. So the two sides of ledger, so the same amount are posted to the two sides of ledger. So therefore, canceling each other. So the same error we did are in two sides of the ledger, both sides. So it will not affect it. Complete reversal of entry. Error of complete reversal. So this error occurs when the double entry for a transaction reverses. That is to say that the amount to be debited has been credited, and the amount that ought to be credited is debited. So when you say debit cash, credit, credit wages, wages, or you credit cash, debit wages. You transpose it. This one's supposed to be this. It will not affect the balance of the trial balance, even though there is an error. And we also have duplicating error. Duplicating error. You know that when error is being duplicated 2 times, even though it will increase, but the balance, the debit side will still be equal to the debit side. So when transaction is recorded more than once, you posted the transaction 2 times, the debit side will still be same as the credit side, but there's an error or so it will not affect. So that's why you need to thoroughly scrutinize. That's when audit comes in. Audit will always check all those things, check it, those check and balances. That's when auditor comes in, look at all those things and able to detect those errors in those accounts and able to put it in the right place. Able to put it in the right place. So identifying procedures to follow when correcting errors. So identify the type of error it is, know if the original entry is a duplicating error, if it is the error of commission or is the error of omission, you know that. Yeah, what we do is what identify the 2 accounts that is being affected. We all know what account is the 2 accounts that is affected, and that's the cash or the things which depends on the transaction we are talking about. Interpret the error and prepare a journal to reverse it. You prepare a journal to reverse it. You prepare a journal to reverse it. The error that will affect the agreement of trial balance. So all this one we talk about is the one that will not affect. That will not affect. But these ones are errors that will affect the agreement for balance, for trial balance to not to agree. When it's a one-sided omission, you post it in the debit side, you didn't post it in the credit side, it will affect the balance in the trial balance. Or misposting of figures to the account. You mispost figures that you're supposed not to post. You post the right one you want to, and then you post the wrong one. So it will affect the balance. Errors in transfer of total of the subsidiary book. So as you are taking it from the red ledger, you made the wrong calculation. You didn't sum it up well. There was error in when you are summing it up. So it will affect it. 2 entries on the same side also will affect it. There should be debit and credit. You now credit and credit, or you debit and debit. It will affect it. So, or sometimes when you're even calculating your trial balance and didn't calculate it well, so there could be error in that aspect. There could be error in that aspect. Let's now look at a trial balance let's look at another within 5 minutes to look at one question that we have, one practical question that we have. Share. Okay. So yes, so yes, ledger and extra balance. Yes. So we have Mr. Chuku just has to give me extra 5 to 7 minutes so that we can able to complete this practical example. This example. Here is Mr. Chuku having this transaction for the month. Mr. Chuku has the following transaction for the month of January. In the month of January, he was trying to create the account. So now see. So here are the transactions, as you can see. Here are the transactions. Cash purchase, 8,000, cash sales, 20,000, wages by cash, he paid wages, he paid insurance, he said to Mr. Olu, who happens to be a creditor, he said to him. And he's not telling you. So assuming he employed you, he has given you all these transactions, showing you his receipt, showing you his vouchers, showing you his bank statement and everything. And you have seen all these transactions. You now employ, you now say, please, let me record this transaction, balance it up and prepare a trial balance for me. Prepare a trial balance. So how do you now start? Now, as we have said that we need to know all the accounts that are involved in all these transactions. Let's know the accounts that are involved, all those accounts. Cash is there. As you can see, cash purchases. That means from the account, there will be cash. From the account, there will be purchases. From the account, if you look at the next one, you already have cash, there will be sales. From the account, there will be wages. So you open accounts for all these ones. There will be wages. From also, there will be insurance. From the also, there will be Olu, which is the in-person account, which is our creditor. So there will be Olu. So all those accounts, we open it. And now start doing debit and credit. Debit and credit. Debit and credit. And now start doing debit and credit. So I'll be highlighting those ones so that we know which one is it. So let's look at our first transaction. It says cash purchases. As you know, as we talked about, cash purchases. Cash purchases. So if you purchase, what do we do? So which one do we debit and which one do we credit? First of all, you open all our accounts. First of all, you open all our accounts. You can see cash that is being opened, see purchase is open, sales is open, wages is open, insurance is open, Olu is open. You open all the accounts. So we now start posting. The first one says cash sales. Cash sales. That means your purchases will increase. Cash is going out because you are buying. Cash sales. Cash purchases rather. Cash purchases 8,000 naira. You purchase something. So your purchases account is increasing in value. Your purchase account is increasing in value. So what do? Since it's increasing in value, you come to your purchase account, you do what? You debit. You can see on the debit side. I don't know if you can see my cursor. So you come to the debit side and let me coat it with another color. Okay, good. So which is this? On your purchase account, your purchase account has increased in value. Is the one receiving. So you come to the debit side, you put cash, 8,000 naira. Remember, your cash will reduce. So because your cash will reduce, your cash is not giving out. Your purchase will now come to your credit side of your cash. Credit side of your cash. What do you want? You put that credit side, that's purchases on your cash account, purchasing 8,000 naira. You have done the debit and the credit. That transaction is perfectly posted, fine, on your ledger. It's done on your ledger. You are seeing that's the transaction is done. So you just take your eyes off the other one. So all the other ones you are seeing, let's assume that they are not there. So the second transaction, cash sales. Cash sales. So you make sales. It means that cash is coming in. Cash sales 20,000 naira. So your cash has increased in value. Your cash has increased in value, that you have more money now with you. 20,000 naira. That's what you have on the debit side of your cash account. You come here, sales, and you post. Sales, and you post 20,000. So what is the corresponding entry? You now go to the second account, which is sales. You open that account you have opened, which is sales. Then you go and post it at the credit side. You post it at the credit side. So that's why you have your sales account you open. You come to the credit side, then you post. Just post cash, 20,000 naira. You can see. The next one, the next transaction, paid wages by cash. Paid wages by cash. So you can see you paid wages. What increase in value? Your wages has increased because you paid wages. So your wages account has increased in value. But you paid by cash, money has reduced in your cash account. So what do you come in your cash account? You come back to your cash account again. You say on the credit side with 1,000 naira, you credit it. Put under credit. You credit your cash account with wages 1,000 naira. And your wages account that you have opened, now the corresponding entry, which will be at the debit side to come to wages, you now come here, debit side, cash. So when it comes to accounting, it's not about now writing, I posted at the debit side, writing like SC. No, this is how it's being written. And every account officer or financial account person, every somebody who has knowledge of account, when it says this, you're already speaking a language to that person. The person knows what this is all about. He knows what all this is all about. Mere looking at it. So it's a language on its own. You need to understand that language. It's speaking. You need to understand language. Not a Japanese language or Chinese language. It is accounting language, so which we need to know. So the next transaction, paid insurance by cash. You can say again, paid insurance by cash. Your cash has reduced because your cash is given up, has reduced in value. While you paid insurance, that insurance account has increased by 2,000 naira. Because your cash has reduced, you come to the credit side because you credit your cash. Cash reduces, you credit your cash with insurance 2,000 naira. Then the corresponding entry, the corresponding entry So, okay, so trying to check mine. All right, so the corresponding entry of the insurance, because we already credited the cash, because cash has reduced, then our insurance, we paid insurance, it has increased. We come to the debit side of it, and do what? You post it. So you are posting all those transactions into their account. Posting those transactions into their individual account. Then lastly, settled Olu by cash. Settled Olu by cash. Settled Olu by cash. So as you can see, when you settle Olu by cash, that means your cash will reduce. Your cash will reduce. So that is it. So because of that, you debit your cash account with what? Olu, because you pay the 3,000 naira. Then the Olu account you open, then you debit Olu with 3,000 naira. So all the transactions have been posted in the individual account in the ledgers. All the ledgers have been opened. So good. So what next? Because it tells you prepare you are required to record the transaction, which you have done. You recorded all transactions. Then balance up and prepare trial balance. Now, let's now balance up. Now, let's now close all those accounts. So we are doing, if it was for a year, you do everything for that year. That is January, February, March, but we are only doing for January, and these are just the transaction for January. You can see like not just a small work. Transaction for a whole year, you have to have it and do it. So let's now close for cash. The cash that came in was 20,000 naira. Out of that 20,000 naira, purchase of 8,000 naira was done. Wages was done. Insurance was done, 2,000 naira. We paid Olu 3,000 naira. How much will now be left? So 8 plus 1, which is 9, plus 2, which is 11, plus 3, which is 14. So out of 20,000 naira sales that came in, we have extended 14,000 naira. That's why we now have the balance. This is the balance we are taking to February. So as of February, we are taking this balance. So this is the balance, 6,000 naira. It's supposed to put that one in green, 6,000 naira. That's the balance left in our pocket, left in our cash account. So to now make it balance. So just put balance, the amount remains 6,000 naira. So if you total everything, it makes it 20. That's at the credit side. And at the debit side too, you say 20. So we now have balance brought down to the month of February so that transaction continues. 6,000 naira. Balance brought down. So it has to be at the debit side here. Balance brought down 6,000 naira. Good. So we already know our balance for cash book. Now let's go to our purchases also too. Remember, it was only cash that we have, the cash 8,000 naira we have. So it both sides need to balance. So what are we now bringing down? So just balance what do we need to carry down. To balance the both debit and credit side, just say balance carry down 8,000 naira. Then post it in the month of February. It has to come to February. That means as at the end of January, that we are bringing to February, the total purchases we made is 8,000 naira at the debit side. 8,000 naira debit side. So as you can see, and I told you that expenses and assets we always see at the debit side. Then sales. Remember, it was only cash of 20,000 we have here, so we need to balance both entries. We need to balance both entries. So balance it 20,000 naira. Then you bring it down for the month of February. That's why we have here balance brought down the month of February 20,000 naira to the credit side. To the credit side. Wages, same thing too. The only wages we had in the month of January is 1,000 naira. So for the whole January is 1,000 naira. There was no refund and everything. So that's why you have seen the credit side there 1,000 naira. Then you now bring it down. In as much there was no any other adjustment. Balance brought down to February so that we can continue the 1,000 naira. Same thing to apply for insurance. Also true, bring it down and put it in green so that we can refer to it. Then Olu so that we paid. Olu so that we paid. So at the end of, because we are kneeling down, we are kneeling NIL, kneeling that's okay. For January, that's why you can see we are doing the credit side of all those ones, only balance engine. So that means at the end of January, this is what we expended. So we are taking this amount to February. So for continuation, there will be continuation. It will just be added to it. Just be added to it. Then to March, be added to it. To April, it will be added to it and everything. So that is balancing of things, balance of everything now. Then trial balance. How do you now do our trial balance? As I said that both debit side and credit side of trial balance must balance, must have a correct balance figure. The two sides has to balance. The two sides has to balance. So now, what is our balance for cash that we are bringing down? What's our balance that we want to use to prepare our financial statement? So our balance for cash is 6,000 naira. So remind you are not taking 20,000 naira. There is no more 20,000 naira because of what? There are expenses that has been incurred. So you cannot be bringing 20,000 naira again into the account because you made some expenses. You've incurred some expenses. You've paid some money out. So what is left at the end of January that you are now bringing to February? You want to know the position. So it's 6,000 naira. So you bring that 6,000 naira to your trial balance. You can see on the debit side. Your cash is 6,000 naira. You can see. The next account, purchasing. The next account, purchasing. So how much do we what did we purchase? Is 8,000 naira purchases of worth of goods. 8,000 naira purchases worth of goods at the debit side. So you just come to your trial balance, you just take it there, purchase it. You can see 8,000 naira at the debit side. Then your sales, the sales you made, the total sales you made was 20,000 naira that you are bringing. That's sales for January. Just put it there. Sales 20,000 naira. At the credit side. At the credit side. You can say at the credit side. Then what next is your wages. Your wages. At the debit side, 1,000 naira. Your insurance too. At the debit side, 2,000 naira. You can see your wages at the debit side. These are expensive. These are expensive wages, insurance. And your load that you pay also. Your load that you pay also. You can see like here. So paid Olu, which is also here. And at the end of January, you say your trial balance will need to balance. So to sum it up on this side, 6 plus 8 plus 3 plus 2 and everything, it makes 20. While the credit side is 20. So it shows that yes, this is balanced. It shows that you are doing the perfect work and you go straight to your profit and loss account. Instantly, you go straight to your profit and loss account. That is how it is being done. So when we now talk about error that does not affect trial balance, for example, so some errors that we say does not affect trial balance. If we now say that one transaction we omitted, let's say we completely omitted paid wages by cash, it's not there at all. If it's not there at all, it means that it will not also appear in your cash account 1,000 naira. So let's assume we remove these wages to 1,000 naira. We remove it because we omitted it. Your balance will be 7,000 naira. So it's not affected. And this wages itself as an account too will not even be there. So it shows that at the end of the day, your cash will be showing 7,000 naira because we completely omitted wages. So your cash will be showing 7,000 naira, and because of that, it will not affect the balance. It will still balance. So these are errors because it's a complete omission. It's a complete omission and everything. So the same thing applies to if we're supposed to post another amount, maybe 56,000 naira, and we posted 65,000 naira. It will not also affect you because it's the same amount you are posting in the debit, the same amount you are also posting at the credit side. So because of that, it will not really affect it. So this is what we are talking about when it comes to the fundamentals of accounting and everything. But the main aspect, which is P&L account, we will not be able to, cannot you cannot do everything as just within this hour. So I'll give room for any form of questions that you might want to ask or this about. If I should go to another topic, I'm very sure that we might not be able to finish through. We might not be able to finish. So I would like to stop here for any questions relating to accounting. What has accounting got to do? What has accounting helped you? How have you been able to how you can hear that?
Yes, I can hear you. I can hear you, Mr. Samuel.
Okay, all right. So let me stop here. If you have any question, please just take it. Let's look at it. Which one do you think you didn't understand very well with the few minutes that we have? Because I don't want to pass at least 2:30. You can finish even before 2:30. Then we continue all other topics. But we need to just ensure that we digest this one very well. We enjoy this one very well before going further and further before it gets complicated. If you have any questions, please let me know. Just you can unmute and say it, or you can throw it into the classroom so that we can talk about it. Because we will be now going to our next class. We'll be looking at bank reconciliation statement, how you can reconcile your bank statement with your cash account. This is very important. As an accountant, you need to know how to reconcile what happened, what are the things that affect the bank statement and this and that. So we talk about bank reconciliation statement when it comes to that. And all other topics, we still talk about P and profit and loss account. We talk about all other accounts. We talk about all other accounts. So why is it important that we have accounting records? Why is it important that we need to keep record of our accounting, of our transactions? Why is it important that we need to keep record of our accounting? So can you please just let me know from the chat box, why is it important that we need to keep record of our accounting? Why is it important that we need to keep record of our accounting? Anyone? Anyone? And I just want us to take another example of practically look at Nigerian budget also too, trying to check so we can just within the few minutes we have, so we're able to know what to do. Coming details of Nigerian budget. I'm trying to get it. 2025. So what are the things to look at? As an accountant with the little knowledge now gotten, to look at the budget. So how we able to dissect it? How we able to dissect it to know which one is right, which one is not right, if they are doing the right thing, you know what trajectory is the Nigerian going through. How are they going to fund the budget and everything? So you need to know all these things. So as that so you can say that Nigerian budget for 2025, I'm trying to look at it, they call it a restoration budget. They call it a restoration budget. And it is about 54 trillion. That's Nigerian budget for you. That's what the budget is. 54 trillion. So which was passed by the executive, the National Assembly. 54.99 trillion. That's the budget. So it was a 41.9% increment from the previous year. So when in the country, Nigeria has a budget of 54 trillion, first of all, ask yourself, how would they get a revenue of 54 trillion? How will they get a revenue of 54 trillion? First of all, you need to have. So that's why you now start going to, okay, where will they get revenue? Where are places they will get revenue? I'm trying to look for. So So the government aims to generate what the government aims from that 54 trillion, government aims to generate a revenue of 36.5 trillion. Imagine. So that means we are running a deficit budget. Sometimes the budget, there are three types of budget. There we have a balanced budget. That means your income is equal to your expenditure. So all the income you don't realize that you know that you are going to realize is the same the expenditure you are spending. Balanced budget. But you have deficit budget. That means you are even spending more than the amount that will come in that you realize. So that means your expenses is more than your revenue. That's deficit budget. And we've always been running on deficit budget. And we have surplus budget. It shows that your revenue is way more. Your revenue is way more than the expenses. And I don't know when we as a country ever, I can't remember, I don't know, there must have been, maybe it's time of one or thereabout, there's always been deficit. So if we have a budget of 54 trillion and we can only get a revenue of 36.5 trillion, that difference, where do we get it? And the revenue we've gotten from the oil revenue, it will be gotten from oil, it will be gotten from tax, it will be gotten from all other things. It will be gotten from all other things. The remaining balance, where will they get it? As I've said, that is where they now start looking at the international creditors, the IMF, the World Bank, to get all those revenues so that they're able to fund our budget and everything will be done accordingly and everything. And I say, mind you, if that money borrowed was now being used, you now start paying, if it's for personal cost, start paying salary instead of being used either to build more railways, schools, hospitals, and this and that will generate more income for government. It's better. Then you can say, yes, it's fine if they can go ahead and borrow. But the moment they start now using it, siphoning it and putting it into their own pocket, then something is wrong. Something is wrong. So let us know what capital expenditure entails and let us know what revenue expenditure entails. So this is assignment for you. Take up the Nigerian budget or go into search Google, look at Lagos State budget, look at federal government budget, look at the capital expenditure, look at the revenue expenditure. Let's see. Look at the revenue. Where are they going to generate those revenues? Where are they going to get those revenues? And the expenditure. What are the things they want? What are the capital aspects of it? Every budget, capital must be more than revenue. Capital expenditure must be more than revenue expenditure. At least capital should be 70% or 60%, while revenue should be 30% or 40%. But the moment your revenue expenditure is now more than your capital, then that's a red flag. It means that you are paying more salary. You are using the money you are getting to pay more salary, to pay more travel allowance, to pay more training, to do this and that, than developing your country. So when you are doing that, it means that there will be in the future there's something is going to go wrong. Something is going to go wrong. And that's why we say that in government here is better that they already sold the future of our unborn generation. They've already sold it by collecting loans. So assuming they are collecting this loan and they are able to do good things and you are seeing it, then we know that yes, the future is bright. But with what is going on, can we say the future is bright or the future has already been sold to the Chinese people? So don't be. It happened to one of the African countries that they had to take over the economy because they could not fund it, they could not pay it. They were borrowing and borrowing and borrowing and borrowing. So as it happens to businesses, it happens to countries too. It happens to countries too. So reason why accounting is very important. Accounting checks all these things. So I think this is where I'll put a stop to it. Next time I would like you to take your time to read through all what we have talked about because we are going more into this accounting and accounting. So you need to have a thick skin. You need to be resilient. As you are going more into it, you get more and more. You are going deep and deeper into it, and it's very interesting if you can pay full attention to it. You can pay full attention to it. So if there is no any question, I've given you an assignment which I will ask next time we meet. Budget of Lagos State and federal government, the revenue, how much is it, and let us know how do they want to generate, how will the revenue be generated. Then the expenditure, what is the capital expenditure and what are the revenue expenditure, the amount. So that will be what we talk about before we now start moving to companies, to start opening the books of companies to see their own thing, how everything, what to look at, if this company is viable or this company is shaking, this company is about to collapse. What are the things you look at? We all know all these things the next time we meet. So thank you very much. I really appreciate your time and for this opportunity. So, Madam Mercy, can you please?
Yes, thank you so much, Mr. Sam. Yes, I enjoyed your class, and thank you everybody for joining us today. I don't know if we have any question. I know because he has been asking if we have any, and no one has responded. So I believe we do not have any question. Mr. Sam, please, I don't know, you are going to help me send the assignment so that I can send it across to them. Is that okay with you?
Yes, it's fine. I will.
Okay. Thank you so much. So I appreciate every one of us for joining, in as much as we all joined late. Please, I implore everybody to always join the class on time. If we start on time, we will end on time. So we need you to always come in on time. And also let us know whatever the challenge would be or could be that would make you not to be in class. All right? Thank you so much, everybody. Please, we have the feedback form. If you can hear me, please, we have a feedback form in the chat room. Kindly give us your honest feedback. We want to know how today's delivery was so we can have a possible way of improving our lecture delivery. Please do so. Thank you so much. And for the assignment, is going to be sent to your different groups in the coming week, as well as the lecture slide and as well as the YouTube recording link, which is accessible in your Telegram platforms. So ensure that you have joined the Telegram group if you have not, because all information is going to be sent to that group. All right. Thank you everyone for joining us today. And if you are still on this call and you are yet to make a payment of your registration fee, which is 10,000 Naira, please do well to do so that you will be given your certificate at the end of this course. All right, so I think that is all from my end. Follow us on all of our social media handles.